Hi, and welcome to Venture Capital. My name is Steve Torsa. I'm the founder and managing director of Wholesale Investor. Today is all about empowering innovation and ambition. The focus for Venture Capital really started about 12 months ago, where we started thinking about how the bringing together of the ventures, which is obviously going to be featured today, and also the capital, is really what creates a spark that ignites this entire space. And what it goes back to, and it started from me actually watching a documentary on Thomas Edison, where I realized the power of that alignment is what makes this all possible. We are absolutely passionate about innovation, and we're passionate about how we bring it to you and how we keep on building the ecosystem going forward. So today, we're bringing this to you, but we're also doing it with our partner, AusBiz TV. I just want to say a big thank you to Kylie and the team who have been passionately helping us bring this to their audience as well. As I mentioned before, everything we do is about creating an opportunity. Everything we do is about building an ecosystem and about creating cross-border opportunities as well. We know from experience that this event today is being watched not just in Australia, not just in Singapore, not just in the UK, but by many countries around the world and many different investment groups around the world. And we're very proud to be able to bring you the opportunities that are going to be featured. So the biggest thing I'll say is welcome. Welcome to the event. Welcome to the opportunities, and we appreciate you being able to join us. Today, we're going to have over 15 innovative companies presenting. We have got many different sectors being featured at the event, from technology, health tech, fintech, life science. There's some unique VC funds being presented as well. Many different sectors are featured, and that is what makes our events quite unique and quite special. And you'll notice that you actually see these on the Chris page, so you're most likely watching this on the Chris stream page. Have a scroll down, you'll see that today is just filled with some incredible companies and the founders behind those businesses as well. That is what we are bringing to you today. Not only that, but we're also going to be kicking off the day with a keynote talk and interview with John Sharp, who's the founding partner of Hatcher Plus. Now, I was fortunate enough to do this interview with John. It is absolutely fascinating. John is one of the most insightful, intelligent, and how can I put this? The way he thinks is unlike anyone else I've spoken to in this space. So we're fortunate enough to have about a 20-minute conversation talking about what the past of venture capital has been and what the future looks like. And I tell you, the way he is looking at venture capital is unlike what I've heard before, and you'll be fascinated by the insights that he is bringing to the table. More than that, we're going to be having some unique panel sessions which are looking at some key areas, and I'll go through that in a second. And also during the day, for the investors that want to add value to their companies, this event is not just for investors, this event is also for founders as well. So we've got some business talks as well. So we've got Alicia Lycos, who's going to be talking about how to build a high-performing team. We've got JD, who's going to be talking about how to build a sales machine, right? And also we've got Katherine Heathcote from Austrade talking about how Australian companies can actually build and expand overseas, which has always been passionate to us. Now, as I said, we're kicking off with John. The insights that he'll bring to you said you'll absolutely love this session, and I recommend watching it maybe even twice, because as I said, for me, I learned more from that session than I have from many of the interviews that I've done previously. The team that we've brought together for the On the Rise panel session. Now, the reason it's called On the Rise, because we wanted to take a look at a few key areas. So on one side, we've got the moderator, Gelix Ventures, who made some very fascinating investments and have been doing an incredible job of building their own ecosystem and made some really great investments over the last period. We've got Niv Dagan from Peak Asset, who's going to be talking about medicinal cannabis and also mushrooms. These were areas that were previously taboo that have now got the attention of the investment space as they become more accepted. But more than that, they've got so much research behind them as far as the health benefits they provide, or the different the different areas that they're preventing or assisting. But more than that, the mental health area as well. So that's a fascinating component by Niv. Then we've got cryptocurrencies with Henrik. Said, I've known Henrik for some time. So when you see what's happening in that space, most people think that crypto is sort of around Bitcoin. When you understand what's happening in the decentralized finance area is absolutely fascinating. But more than that, said, when you see the volumes of trades that is going through in that area, it will be surprising to most people. We've got Vpply from Kaspersky. We're very lucky to have one of the leaders actually in cybersecurity talking about what he's seeing in innovation in the cybersecurity space. And we've got John Ruddick from Planet Arc Power. Renewable energy is one of the hottest areas that I've seen, and it's really come up over the last 2 to 3 years. You know, not just renewable energy, but the infrastructure required for it as well has also become a fascinating area. So they're going to be covering that in the actual panel session. Now, the way we've actually set up this event, and then we set them up all, is that you engage with the companies via CRISP. You are watching this stream on the CRISP stream page. As you scroll down the page, effectively all you need to do to engage with the companies is to click on the links connected to the company you want to engage with, request access to their deal rooms, and then you can engage in Q&A with the companies as well. Now, we encourage you to do this because that is how the companies actually communicate with you about their opportunity. So whilst they're presenting, what I recommend is that whilst they're presenting their opportunities, you go on and click, request access to it, and then have a conversation with the company directly, or you can view their profile on the Wholesale Investor page. Now, everything we do is about building our ecosystem. So from here, what I recommend is that if you have people in your networks that are relevant to this space, whether it be investors, whether it be founders, whether it be industry participants, whether it be legal, accounting, etc., invite them to one of our events. This is how we build, this is how we grow. We've been able to build an incredible ecosystem of over 30,000 people around the world who are looking to invest in the venture space. We are absolutely passionate about building that consistently, and we want to do everything we can to help bring this space together and help it continue to grow, regardless of what is happening outside of, in the sort of normal environment. Now, obviously, COVID has provided many different challenges, but we have watched our ecosystem continue to build, continue to push forward, and continue to thrive. And we want to encourage that, and we want to push that as much as possible. So lastly, I'd say thank you and welcome to Venture in Capital. I hope you enjoyed the presentations throughout the day. Hi, and welcome to my interview with John Sharp, who's the founding partner of Hatcher Plus. Now, obviously, as part of Venture in Capital is all about bringing together, like the whole thesis of it is how do we bring together innovation and then how do we bring together capital? Because when those two things happen, that is effectively when the magic starts to being created. Now, I've been absolutely fascinated by John's work for some time and have been following him for some time. So hope you get a lot out of this session. Now, first I want to say thank you very much, John, for joining us and welcome.
Thank you. No, it's a real pleasure to be here.
Now, to start off with, can you give us a bit about your background and history before Hatcher?
Yeah, sure. Look, I'm obviously an Aussie. I left Australia in the early 90s. I went to the US for a while and came into Singapore around the time that the satellite industry was starting. So that was a fascinating time to be here. A kind of small industry in terms of people, but fascinating to be launching rockets and putting satellites in space, and just a lot of fun.
The fun stuff.
And, yeah, really was fun stuff. And I was part of a little company called World Space that raised $1.8 billion in its seed round, which I think is somewhat of a record still to this day. Yeah, it was a fascinating time. And of course, now there's so many satellites up there that people trying to look at the current comet that's in the sky are complaining that satellites going over it every 2 seconds and they can't get a decent photograph.
What year was that, by the way?
This is 1994 through 97. I was working in the satellite business, and then I decided I wanted to learn more about networking and software, so I went to work at A-Star here in Singapore, a software program there, and then I started a cybersecurity company in the States.
Now, just for context, A-Star is a government-led institute, right? And probably one of the most renowned for scientific.
Amazing facility. It was actually, it started as MIT's sister lab in Singapore.
Yeah.
And just lunchtimes at that place were just incredible. The conversation would go from everything from protease inhibitors through to virtual reality. It was really an amazing place to work. And then I went to work on a consulting project for a broadband group in the States. And we discovered that there was a real need for cybersecurity in the home at that time because we were just launching broadband. This is the early 2000s. So we created a suite of broadband security tools and walked into Comcast and got an order for 100,000 units as a little 3-person company. And that later expanded to 2 million units. And we got the same kind of orders from Cox and British Telecom, a bunch of others. So we ended up being the largest OEM antivirus company in the world. We supplied Google, Symantec, McAfee, British Telecom, Telstra.
This startup stuff's so easy, John.
Yeah, exactly. Well, I'm compressing 10 years worth
I'm joking.
Here and the efforts of lots of people that are far smarter than me. But it was just a terrific time and learned a lot about cybersecurity. Sold that business in 2010 to an Israeli company and moved back to Singapore where I had a house and just started doing some angel investing. And that was a lot of fun. It was fun working with these startups and things like that. And I eventually fell in with a group of 7 other angel investors that became a group of 50 guys. And they appointed me to run their investments. And we sort of brought that together, and that became the first Hatcher fund. And so I'd say that some of the investments were actually pretty ordinary that were made. And so it was a case of having to figure out what was going to work and what wasn't going to work and be very disciplined about it. And the other thing I found very difficult about running this small group of investments was just getting the guys to report to us, and putting all this and getting a cap table that was consistent. So at that time I started developing. I'm a software guy going back to the start of this project, and so I started just creating a database and building front ends for cap table management and things like that, like what Carter does now. Yeah, and started building in this whole sort of process, a bit like your CRISPR platform, and some capability it has. And over time, that sort of developed to become a very useful part of what we're doing in the back end, but it's only for us. I mean, we just used it ourselves. And then around 2016, I started doing some very, very rough data analysis. I wanted to understand what was going on inside venture. And what I discovered kind of flipped my whole idea of what was going on inside of venture. I thought, I thought later stage was better, better returns relative to the risks, etc. I thought that it would be possible constructing a small portfolio just to do the whole value add thing, and everything was going to be fine. And what I discovered through this very, very early stage piece of analysis that we did was that you really needed to have a much larger portfolio. And at the point at which I discovered that using 15,000 transactions, I thought, I immediately need some help on this. I'm not a data scientist. I know a bit about data analysis, but I called a friend of mine in Florida called Dan Heathcote, and Dan's amazing. He was a CIO at Bankrate. He grew their revenues from 38 million to about 575 with over a period of about 8 years. Just a tremendous guy, but very, very commercially astute data scientist. And I called up Dan and said, "Look, I've got this idea for creating a data-driven investment model for venture investing."
Now, what's just quickly, I don't mean to interrupt, but what I think is really interesting about this is obviously a lot of people sort of talk about this on listed markets. You're the first person I've heard talk about constructing a virtual sort of portfolio in the venture space. So I find that really interesting as a starting point.
Look, what's interesting to us is when you look across the whole at the way other assets are managed, and you look at the way, say, public equities have transformed themselves as a business since the early 90s. I mean, in the early 90s, if you wanted to buy stocks, you'd call someone at Charles Schwab and they'd pick some stocks for you, and you'd give them a check, and it was all very, very manual, and and relied a lot on that person's sort of observations and understanding what's going on in the market. Now that person doesn't exist.
Yeah.
You grab an account with Goldman Sachs, they put money into this dark pool that has tens of billions of dollars in it, and off they go with this algorithmic trading at the speed of light. It's completely transformed. But venture, if you look back 30 years in venture, nothing's really changed.
Correct. Absolutely nothing.
Yeah. Now, why is that an astonishing statement? Well, because venture guys, if they know about two things, they know about disruption and they know about scale.
Yes.
Those are the two things that venture guys know. And venture investors generally can recognize when something's going to be hugely disruptive and how the efficiencies in that are going to create new value. And they recognize how to scale companies. And the thing that I found fascinating when I first figured out this notion we needed to have a large portfolio working for us was, well, that implies that you need a lot of scale. And so I was just very surprised that no one else had really gone in for scale, with the exception of a handful of guys like Dave McClure at 500 Startups, for example, Y Combinator, Paul Graham at Y Combinator, that out. And when you look at the data, the empirical evidence of what they did, it's really astounding. I mean, Y Combinator has 19 unicorns for 2,100 investments, which is absolutely amazing when you think about it, but also slightly even more amazing is the fact that not only do Y Combinator have a unicorn every 100 investors, Techstars does, Startup Bootcamp does, 500 does, Sequoia does. There's some relationships there that you can see in the data whereby certain types of return profiles accrue to these very large profiles. And so while you may not get a 10x in your portfolio, you'll certainly get a much better result than the average small portfolio. Maybe I should share some data.
Yeah, I think that'd be great.
First of all, this is our engine that you're seeing here. So this is really Dan's purview. He put this together. I thought I knew a little bit about AI when Dan and I got together, because I'd previously been CIO for an AI startup here in Singapore called Thought River. In working with Dan, I've realized how much I didn't know about AI and just what an amazing guy he is.
So firstly, my first impression when I look at this is obviously it's incredibly impressive how you've been able to analyze over 600,000 transactions. And obviously the returns of 700 funds.
Yeah, and people sort of think, well, 600,000 transactions, how difficult was that? The hardest thing was actually procuring the data and cleaning it up.
Yeah.
And we had to go to multiple data vendors. We had to ask a lot of favors from people who ran pension funds and other organizations, and they were all very generous, and they gave us a ton of information, and sort of we had to pull all that into and create similar profiles and everything. But then basically what we did is, and on the venture funds, we must have met in person with about 70 different funds. And then we just called everyone. We leveraged PitchBook and CV Insights and Crunchbase and all the data we could find. But the most important thing we did is we actually created about 4 billion virtual venture portfolios. And what that means is based on these 600,000 rounds, what we wanted to do was remove the partner from the equation. We wanted to basically figure out, if you just took 20 companies from Raleigh-Durham that are broadly in medtech, how are they going to do if you start mixing those up, or if you mix 200 up and you create 20 different portfolios? And what we consistently found was that it didn't really matter how you mix these things up. You ended up with the same returns, and that the simulated returns very closely matched the actual returns from the portfolios. Now, this looks a bit boffinish, these two charts, but just bear with me here because it's actually quite simple being represented. On the left here, you have the results of our 4 billion simulations at various size portfolios. So you've got the 10-year return multiple on the bottom, and you've got the probability you're going to exceed that multiple on the y-axis here. And the awesome thing here is you can basically go into line 3, that red line that you see there, and you can see that if you follow that down to the bottom of the red line, just by tracing looking at the graph here, essentially you've got a 20% chance of a 2x return for a 100 company portfolio. But if you go across to the thick blue line, which is our strategy, everything changes. If you go up from the 2x mark there to the top, you can see that your low case now becomes 2x, your mid case becomes 4x, and your top case becomes 8x plus. And all you've done is increase the size of the portfolio. And so we tested this using empirical data on the right, and you can see the same thing happens identically. So if you're plotting large portfolios like Sequoia, NEA, Y Combinator, etc., what you end up with is just a better return. We call it a more robust return. Better is subjective, but it's more consistent as a return. And so the way that and by the way, everyone always says, yeah, what about Union Square Ventures and some of these awesome guys in Singapore that have presented these fantastic returns? They have done these amazing returns, but they really are outlier funds.
Sorry, just on that, I just want to highlight something, and apologize, this wasn't in, me and you have obviously had a few conversations.
Yes.
I was really surprised by one of our last conversations where you highlighted the lack of returns often by VCs. And like one of the things you highlighted was that often some of the most successful VCs, typically their success is in their first fund, not so much in their follow-on. And what is there any other color you'd like to add to that?
Oh, yeah. So let's look at the next page. So why is the first fund better than the second or third fund? Now, that's not a hard and fast rule, but it does apply a lot. And as we discussed in the last conversation we had, Steve, the thing that's fascinating to me is a lot of investors won't go into a first fund because they think it's too risky.
Yes.
But actually, it's when you should make the bet. If you like the guys, that's when put money in. So what you're seeing here is actually one of the reasons we found why. So this is an analysis. I think this is a couple of 100,000 of those transactions. And what you're seeing here on the left-hand side is 8 rounds of venture investing. Now, these names are used differently throughout the world, but broadly speaking, round 4 is anyone's Series A, and then round 5 is a B, round 6, Series C, Series D, Series E. The very first round we call foundation round because there is a really good name for that. The next round we call angel, and the round after that we call seed. Just to give a profile here, what's fascinating about these returns, I think, is first of all, the angel needs to be explained. And we struggled with this for a long time. We couldn't figure it out. And then when we started looking at the valuations that angels often give companies, we discovered that they were too generous. And we came up with a very pithy quote that angels wear halos. That they're a little too nice, generally speaking. But we discovered in North Asia that this doesn't actually, that in North Asia they're less generous and the angel returns are much better. So this is just a worldwide view of what's going on. But one thing I would take away from this as an angel investor is not to be too generous with the valuation, because the seed guys coming a lot next are going to be less generous with the valuation as a general rule, because they're typically now institutions and they'll bring things back to earth. So this was an interesting thing. But the takeaway from this is if you get money in the number round, 1 round, the number 3 round, the number 4 round, you're doing great because you're above that red line that is NASDAQ.
Interesting. And so when you've actually looked at this, how have you seen this actually play out in real life with a lot of the companies that you're sort of coming across?
We've seen it play out very dramatically, actually. Some of the companies that we invested in, we made over 100 investments last year. And some of those companies are already coming in at I think one of them is at 5x, one of them's at 7x, who had one exit already at 2x. So in the space of 12 months, you can see these really large step-ups in value. And what people also miss, and what we found in our analysis, is there is a much larger propensity, particularly in America, to sell these early companies at a very early stage and exit within 2 or 3 years, which is not something that was previously on our map to quite the degree that we found in our analysis. By the way, on the right-hand side...
Two questions I have for you. Typically, in that foundational round, how much are you typically investing, and how long are you typically holding for? Are you holding for that 2 to 3 year period, or are you holding to IPO or other exits, or what's your thoughts on that?
So one of the things we also found was I called a buddy of mine who runs Adam Street Partners, which is one of the leading fund of funds in the world. And I said, look, can you give me data on how long these venture funds typically hold for? And he sent me back a chart, and it showed that they typically hold for about 16 years. Now, that's not what most venture fund investors sign up for. They sign up for 10 years plus 2 1-year extensions. And so, the 16 years, to find out that was the average and that there are active VC funds that hadn't liquidated after 22 years was a real surprise. Now, telling a 50-year-old or a 40-year-old investor that you're going to be waiting 20 years for money is just not, I don't think it's a good thing to do. So So actually, it's a great segue into what we did is we created an ETN so that you can actually buy into the fund and then trade out of the fund at any time. So our idea here was that if you put $100,000 into the fund and the fund goes 2x in 4 years, you can then go and sell that on the markets. Now, right now, we're on the Vienna Bourse. We're just awaiting regulatory approval to go onto the Singapore Exchange. And that will allow our investors to basically put money into our fund and then dictate the time period themselves that they want to hold that. Because right now the fund dictates how long your money is in there for. And sure, you'll get money back as the exits happen, etc. You're the first guy in line for that. We have exactly the same model. So there's no downside to investing in the ETN. The upside is that anytime you want to get liquid on your investment, beyond about a 3-4 year period of initial investment, you should be able to trade out of it.
And John, one other thing I love about the way you're thinking is that, and this goes back now, obviously you're focused on your strategy at the moment. What I found interesting was your team makeup. So typically, what would a typical VC structure look like, and what does your structure look like on a team perspective?
So we've automated literally everything, right? I mean, everything we do from deal flow. Like we looked at, I think something like 10,300 deals last year to invest in the 100 or so that we invested in. And so we're able to do that because we apply AI filtering, we apply ranking, we apply all sorts of methodologies. What we're able to do in conjunction with all the accelerators that we work with is leverage a massive team globally, but maintain a very small team ourselves. So we have 10 employees. Just as a contrast, I was on the phone with Plug and Play a couple of weeks ago, and we're just teasing each other about how many investments we'd made because we're neck and neck with them for a long period there last year. And they'd made twice as many investments as us in June. And I said, yeah, and remind me how many employees you have. And they said, well, we've got 800. I said, we've got 10.
But all those 10 people, they're typically engineers and data scientists, aren't they?
Yeah, yes, exactly. Yeah, there's only 3 of us that are working on the sort of front end on the commercial side. And everyone else is working away on helping us on the automation, the business process automation side, and on all of the integrations that we do with the various data APIs and things that we use.
And John, if there was 3 takeaways that if you were to summarize what you've learned since sort of 2015, 2016, what would be the 3 big takeaways that you would sort of hand over to other investors looking to get into this space or already active in this space? What would be your 3 key takeaways for them?
My 3 key, that's a great question, Steve. I think my takeaways would be, first and foremost, talk with other investors and find out what they're doing. We got on a plane, we went and met with 70 VCs, and what we discovered was there was a real need for something like what we're now doing. And we could see, we also just recently hired the Insight Group, Clayton Christensen's consulting group, to do some analysis of what we're doing. And what they came back with was fascinating. They see the venture capital industry moving very much towards where we already are and where we're heading to. And so I would say talk with other investors that are similar to you and try and understand what they're doing and learn from that. I've learned so much from talking with family offices over a couple of years as we've been building this. And one thing I've learned from family offices is they want to deploy a lot more money into venture. That's for one, and into the kind of deals that WI puts out there. The second thing I've learned is they want to get involved. They want to do this.
Sorry, the internet just broke up.
And they're less inclined to do it. It's because what I found and what The Economist has actually found through their research. Let me summarize. What I found from talking, from looking at The Economist research on this is family offices want to invest about 25% through a fund and about 75% direct. And so one of the takeaways from this is what we want to do is be able to present family offices with deals that they can invest in on a zero fee, zero limit basis. So when they invest in our fund, we're really creating a hedge for that money. And we're saying, we believe this will be 4x in 10 years. So if you put $1 million with us or $100,000 with us, let's say, we believe we can turn that 100,000 into 400,000 in 10 years. if you have an allocation of 500,000 that you want to put in these early stage companies, that frees you up with the other 400 to do interesting things that you may find either through WI or through us on a direct basis. And we think that's really the future of this. We think there's going to be a lot more direct involvement. So that's one of the takeaways is understand what your peers are doing and understand where the trends are going. It'll make a lot easier for you to do that. And the second part of that is it will enable you to syndicate. Because if you have groups of people that are like-minded around you, and one thing I've noticed from our involvement with the Keiretsu Forum around the world is there's a lot of doctors involved in that network. So when a deal comes in that's medtech or biotech, the doctors are all over it and they syndicate it and they understand it. So getting together a like-minded group of investors, I think, is the second takeaway for me. That can really be helpful if you're an individual investor. And the third thing I would say is really just look at how you're running your own processes and how data can help, because I've learned so much just from looking at what our data has shown us in the last 3 years. So many of my biases have had to be upended and changed out for new biases, I guess, based on what we've seen. And this has been fascinating. A lot of what I thought we were doing right back in our first fund, and we've had a great run in our first fund with a 17% IRR. We'll eventually do 20 plus. It's been a good thing. But I wish I knew back when I was managing that. I wish I knew to build a bigger portfolio, and I wish I knew how to better manage risk. And what I've learned from everything that we've looked at in the last 3 years is how to do those things, is to generate better returns and better manage risk. So that's the takeaways I'd leave.
And I have to say, like, our thesis is in line with that, is that what I love about what we do is typically we want to attract investors that are typically looking to be more active with the company because they've got some sort of skill set or background or networks that can add value in some way, shape, or form. And as I've highlighted to you, the way I see the future of the future of WI is helping create those syndicates for companies and for investors, so that that alignment of thought, that alignment of participation, et cetera, can help it create additional value.
Look, it's amazing what you're doing, and I think you're exactly right. And I've noticed that the investors that you guys have sent to us already, just going through their backgrounds and their profiles, they've got a lot to offer any company that they would invest in. And so I think there's definitely the money side of it and the investments of it. But what you can add to that company can be profound, even if it's just introductions. That's a lot of it, as we all know, like knowing how to contact someone is a really critical component to it.
Well, I know for myself, like my shareholder base now, and we've done a lot of work, we've raised money over the last 14, 15 months. And the background of my shareholders range from private equity, venture capital, angel investment, wealth management, funds management, property, and from, 7 different countries. So it's not that this and what I love about the way you presented your data is this is effectively, international. This is from an international perspective. And this is, I said, I cannot but take my hat off to you. And I know, I think to provide some sort of context, how much would you say you've invested into building out this data structure and this sort of platform that you're bringing forward?
We've raised over 12 million USD to build this out. We've spent about half of it. So it's been a really massive effort, and it's included a lot of outsourcing and other people brought into the mix. But we're now at a point where we've got our structures firmly in place with respect to the investment models. Yeah. So now what we're looking to do is understand more about what's going on in impact, for example. We're fascinated by that area, and we think the data can bring a lot of understanding to that. So there's various, really, now that we're on this sort of firm base that we had to work so hard to get to, and all that time cleaning up and everything, now we're in that really lovely area where we're getting ready to launch into a whole new areas of analysis. And I think that's going to be really exciting.
Well, to finish off, I just want to say thank you very much, John. Everyone, you can find out information about what sort of John's doing on the Chris platform and on WI. I highly recommend you sort of either register interest or get to know what the Hatcher Plus team is doing, because I said, well, I've had now, I think 3 or 4 chats with John, and each time it's just like I don't know. I love that sort of that thesis chat. I love digging into the data. It's just the way you are thinking about things is very different to how most people I come across, and I absolutely love it. So thank you very much for your time today, John.
Thank you very much, Steve.
Our first presenter to kick off our showcase today is Koopman Securities, an ethical community investment involving long-term improvements in local infrastructure and sustainable farming programs in Fiji. They have an experienced team and the support of the local community. Here to discuss the opportunity further is Director Richard Granger.
Hi, I'm Richard Granger from Koopman Securities, and I'm really excited to be able to present this incredible opportunity today, which is the APR project in the Southwest Pacific. And you're going to see in this presentation, this is a press button, ready to go project that will deliver immediate cash flow whilst proofing up large blue sky potential. A bit of background, the APR project is something really close to my heart. At Koopman, we strive to support projects that contribute to the circular economy, and this project really delivers with a social conscience that has mutual benefit. My mother was Fijian, and I'm a distant relative of that guy in the top left, Ratu Timothy Daniel, who's the APR chairman and also the highest ranking chief in Fiji. So the key benefits for Fiji here are strong and harmonious relationships between APR and the landowners and their people, and employment for the local population, and long-term improvements in the local infrastructure. In this slide here, it shows the location of APR, and right along the ring of fire to PNG, you can see the same type of geology with the likes of Panguna and Lihir mines, and our initial geological information indicates the APR site has the potential to be as big as the Octedi mine. So this is a high value neighbourhood with this map showing the location on the main island of Fiji. You can see some heavy hitters in the area, Newcrest down the road, and if you look at the Tavatu mine, you can see that the Lion 1 share price rose 452% in 1 year to February 2020 off the back of some of the discoveries. This slide shows the large-scale gold copper porphyry site, and you can see here the three main projects. Wainavisi on the right, which is our near-term cash flow project, and in the middle is sitting Wainaviti, and Tau Novo on the left. This is the big one. This is the big blue sky play, which is that gold copper porphyry deposit with the large-scale delivery potential. If you look here from section A to A in the map, it depicts the topographical view through the three deposits. Again, in that diagram on the right, you can see the magmatic phenomenon that's occurring through the three projects that's pushing all those metals up. This isometric view on the right is a combination of information from the exploration history, indicating the total resource in those projects. So the metallurgical test work's been done in those three places, ALS, Metcon and AMML, as well as by Trafigura in their own smelter test, which resulted in that offtake agreement with APR. So with that test work being completed to an advanced stage, we require some further test work and ongoing supervision by an independent JORC competent person to enable the JORC compliant public reporting to our investors, and also to see that improvement of zinc concentrate to a greater than 51% consistency. So I think everyone's aware of the excitement in the gold market right now, which means the timing's excellent. You can see here that with that test work being done and that the metallurgical test work moved to an advanced state, this deposit in today's marketplace would have an upside potential similar to that shown in the Boda and Thursday's Gossan projects. It's important to note, this is not an exploration play when you're waiting 5 to 10 years. This is push button ready to go and should show profitability in the first year of operation. So what needs to be done? How are we going to do it? 1, we upgrade the pilot plant. 2, process the stockpile. And 3, whilst at the same time doing the work to upgrade the current information to a JORC report to go to IPO. The benefit of doing it this way is the immediate cash flow and a consolidation of information to allow us to develop a strategic mining plan. Why do we upgrade the pilot plant? Well, by upgrading the pilot plant to a processing plant, it gives us early cash flow and that ability to supply into the Trafigura offtake agreement. So running in parallel to the JORC code upgrade gives us a far stronger proposition to go to IPO. Here is the APR team. APR run by a well-balanced team that gives us a mix of corporate and technical ability and local representation. Okay, so this is the exciting part of the presentation. I keep reiterating this is a press button startup. The initial Wine VC project has all approvals in place, including the surface leases, no native title issues. It's 60 kilometres from the CBD and a major port with all-weather access, 25,000 tonnes of stockpiled inventories representing $30 million to process immediately to fulfil that Trafigura agreement, 1.1 million tonne resource estimate, and projected cash flow of 61 million from concentrate sales in the first year of operation. The offtake agreement in place with Trafigura pays 90% of the value at port before it ships from Suva. Here, the blue sky potential, we've got the three core projects, the Wine VC at 1.1 million tonnes, the silver and zinc at 50 million tonnes, and the gold copper porphyry at 1 billion tonnes. There's been a current 2020 third-party evaluation done, and Project 1 has a net present value of $18 million. I keep reiterating this is ready to go. There's no waiting 4, 5, 10 years. It's ready to go. The JORC coding is just a formality where we're confirming the existing information's ratified alongside a number of selected drill holes, and then we're ready to go to IPO on the ASX. So how are we going to use the funds and what's our exit strategy? We're seeking to raise $4.5 million. The 4.5, these funds broken up into one, the debt funding of 1.75. 1,050,000 would retire the current bank debt, 200,000 to establish a public unlisted company and transfer existing shareholders to the new Australian company ready for ASX, and 500,000 to upgrade the existing drilling program to move the drilling information into a measured resource to comply with ASX rules. 2.75 million to upgrade the pilot plant to a commercial operation, allowing the processing of the existing stockpile and future development. It's important to note the debt funding would be a convertible note at 16% interest for a term of 1 year, and at this point the note holder would have the option to convert the debt to equity or act on the convertible note, claiming a capital and interest payment. And the debt funding of 1.75 would be fully secured through a fixed and floating charge over the assets of the company, except for the new processing plant. The exit strategy is the IPO on the ASX within 18 to 24 months of receiving the funds, with a fully operational mining facility producing gold and zinc concentrates sold to the offtake agreement with Trafigura and showing first year profitability. So thanks for your time today to hear all about what I really believe is a tremendous opportunity that delivers on 3 fronts. 1, the press button ready to go cash flow opportunity. 2, the massive blue sky potential as we take it to IPO. And 3, a project that would deliver enormous benefits to the local Indigenous Fijian population. You can contact myself or Daryl Young at Koopman Securities for further information, which is also all there available in our data room. Thank you.
Thanks, Richard. Our next speaker, Sean Fox, is Managing Director of RAIC. RAIC is an investment manager specializing in developing high-yielding investment opportunities. Their unique approach involves working together with their project partners and investors, understanding the specific needs of both the parties and then creating bespoke investment opportunities to suit their needs.
Hi everybody, Sean Fox here. It's a pleasure to be speaking at another Wholesale investor event, the Venture in Capital. So thank you for joining me today. In this talk with you today, I'm going to be talking about our company. I'm going to also highlight one of the projects that we're raising on at the moment. So firstly, here at RAIC, we've got many different companies in the sort of finance world, from retail fundraising, wholesale lending, international monetization of banking instruments, and obviously venture capital. So we'll look at a lot of different projects. So depending on what hat I need to be wearing at the time when I'm talking to you, I'm either trying to get money from you or give you money to buy something. So Look, today I'm going to be talking about our current retail fund, and anybody can invest, wholesale, sophisticated investors, institutional. We've just registered here in Australia as a full retail offering that anybody can be involved with. I want to break this up into two different categories. There's the asset which I'm going to be talking about, which is the sandstone quarry investment that we're purchasing, but also how and why we purchase. And I'd really like to highlight that today in a talk. I think it's important at conferences or sort of events like this where we are talking about big asset classes and good value for return, and finding a decent asset is also important to understand what makes a good deal and what sort of makes a wholesome deal within there. So the asset I'm going to be talking about today is a distressed asset. I specialize in purchasing a lot of distressed assets. I purchase them very differently than most people. I don't come in devaluing the asset. I don't come into a position where I want to cut the best deal and somebody's left in a worse state than when I found them. All of our distressed assets that we purchase, we actually leave the owners involved in the project. So we'll leave them 20% equity in there. We'll pay off all of their debt. So in the instance here with this sand mine, we should have purchased this for somewhere in the realm of $60 to $70 million. It's a huge asset. It's 113 hectares. There's a million tons a year extraction limit. It's a full sandstone quarry. So there's a whole bevy of product on the actual site itself. And we've already got identified resources in the ground. So I've got two rules when I purchase my mining assets. Number one is I never go on a treasure hunt. You've got to have defined core samples and JORC reports and be able to validate the material that's there. And then it's a job of logistics. Also, it's got to have permits to mine on the actual site itself. And that's what we have here. So we've got full permits to mine. We've got identified resources on a very small portion of the site of 20 million tonnes, and that's got a value on it, very conservative value of about $1.5 billion gross profit over the course of the 20 million tonnes, and obviously with a million tonnes a year extraction limit, that's 1.5 billion over the 20 years, or call it 75 million a year. Now that is gross. After all expenses, but before taxes, only because this site here, there'll obviously be the benefits of franking credits, etc. So we individually want everybody to get tax advice on the site. So that's the asset itself. I'm not going to keep you all too long. It's a big day of viewing today. So that's the asset that we're raising funds on. Now, how we raise is important. So we professionally purchase assets within this fund. Normally, we'd like to do something every 3 months. Obviously in COVID, everything's slowed down quite a little bit. So our product is always the same. It's always a 2-year fixed term on the loan. We generally pay that back sooner, but I'll explain how in a moment. We pay either a 10 or a 12% fixed interest. It's not really graded to risk. We don't really play in the risk space. It's graded to sort of emotional commitment. So if it's something normal, if we're doing just a development side, it'll be 10%. If it's something unusual like a sandstone mine, then we'll do the 12%. So this is a 12% fixed interest. We pay the interest yearly in advance, which it's not really many people doing that. And we also take no fees, so you get the full 12%. So if you're investing something with me today, I'm going to pay your first year's interest to you up front. I'm going to give you a year's interest a year later, and at the end of that term, you get your full principal back. Now, I don't mess around when it comes to securities. As much as we're purchasing these assets, I treat them all as individual and separate to us. So we take 2 first registered securities. We take a first registered mortgage over the land, and we take a first registered charge over the company, which for me, arguably, that's the stronger of the 2 securities, where we've got basically like a mortgage over the bank account. So we allow the company or the mine to spend all reasonable costs to run itself, and then 100% of profits must go to pay the loans down. So that's why our loan terms generally don't go the full 2 years. We pay them off sooner. Now, that being said, 12% for 2 first securities, it's fantastic return, especially a mining asset. It's Australia, we're built off resources, and it's sandstone. So, sand is the second most in-demand commodity after water on the planet at the moment. So have a bit of a Google on world sand shortage and you'll see what I mean. So for me, with the mining assets we're looking at, this is my favourite. Now, that part of the investment alone is fantastic, 12% returns, interest year in advance, but the real reason people invest with us, my philosophy in investing is I like to be paid continually for work that I do today for the next 40 years. So I'm a big believer in creating passive income or creating money through ownership in small amounts of equity in as many companies as I could possibly get. And this is obviously the crowd to be talking to. This probably resonates to a lot of you at the moment and why you're actually here looking at this. So to that effect, what I do is I take 15% ownership of the asset, so the land, the business, the machinery, the permits. I put 15% into a trust, and then depending on how much of the 18 million that we're raising in this round of the loan that you contribute, that's how much of that 15% equity that you get in the actual asset. Now, don't confuse this with the loan. This is not a convertible note. Your loan is a loan. You're getting your principal back regardless. You're getting your interest, and the equity is like a thank you for being involved in the process with us. And you hold that equity forever. So there's no restriction on that. You can gift it, sell it, use it. The way that I run the company is what I call a cash box. Once the loans are all paid back, it's only 18 million that we're raising. Once the loans are paid back, I'll leave 20% of the equity 20% of the profits in the company to emergency cash flow expansion, and the other 80% every quarter is being paid. So these would be full dividend paying shares with the actual business. So you treat it as a business partner. Obviously right now you might be thinking, it sounds too good to be true. I get that all the time. We've been doing this for 4 years. It's the same structure. My philosophy is, if you're not greedy, you make more money. Share everything with everyone in the value chain. So the original owner of this site, who was in distress for other reasons, he's still got 20% ownership of this. I'm purchasing this asset, so my company's going to own 50%. So the least I can do, if I'm going to use all of your money to buy my asset, you should get a share of it as well. So, and that is our philosophy here at RAIC, is that everybody gets a piece in the value chain. So guys, look, I think I'm getting pretty close to my 8 minutes. I'm going to leave it there, but if you'd like to get in contact, you can get in contact through the deal room, through our wholesale investor site, directly through our websites, which is probably here on the screen somewhere. And I would love to hear from you guys soon. Thank you so much.
Thank you, Sean. Next to present is Hatcher Plus. Hatcher are using human and machine intelligence, process automation, and a massive global network of co-investment partners to build a diversified portfolio of early-stage venture investments. Here to talk further on this opportunity is partner John Sharp.
Hi, everyone. Today we're going to be talking about Hatcher and our strategy, which we like to call a new approach to venture capital. It's really an evolutionary approach based on what we've learned from managing a first fund, which was quite a successful fund. It's done quite well. But at the end of that fund, we really felt that it was a time that we really took a look at how returns are generated in venture capital to see if there is a different approach that could be used to generate more predictable returns. And that really is our overarching goal as I walk through this presentation. Our basic strategy is that we're using deep learning, process automation, and a global network of deal origination partners to build the world's largest, most diversified venture portfolio. And the reason we're doing that is that we've found through our research that a very large, well-diversified portfolio reduces risk, it generates predictable returns, and it creates the broadest possible range of co-investment opportunities for investors. We've found through numerous discussions with investors that many people prefer to go direct rather than through a fund, or they would like to use a fund as a feeder vehicle for doing direct investments. So what we're trying to do is accommodate those needs for predictable returns and for high-quality co-investment opportunities. So let's talk about why we're doing this. Most asset managers, if you look at most people that are trading public equities or anyone that's really involved in managing real estate or other assets that are non-venture related, they really invest systematically. If you look at the way public equities are traded, people are using data, they're using deep learning, they're using algorithms. There's a lot of process automation, and there's such an emphasis on that people are even studying how they can do transactions at the absolute limits of the speed of those transactions. If you contrast that with how we generally approach venture investment, that venture investment is typically a very manual process. Deals take a long time to do because of that manual process. The diligence is typically based on quite sort of antiquated ways of doing diligence, and the data gathering can usually be quite thin and time consuming. So the other thing we've found from talking with lots of VC guys is that portfolio strategies tend to be driven more by these kind of time-based and resource constraints and less by math. Again, if you're creating a public equities trading portfolio, you're going to start with the outcome and you're going to build the portfolio strategy around that. Whereas we've found that most venture investment strategies, they can often be driven more by the resource constraints. How many partners do we have? How long does it take to do deals, etc. And finally, the biggest problem we found when we're managing our first fund and looking at our peers around us who are also managing funds is that outcomes tend to be unpredictable for everyone but the largest players. If you look at the venture capital business as a whole in the States, about 66% of venture investments are made by 12% of the funds, right? So what you've got there is very large portfolios being created, and they have the effect of almost creating an index fund return just because they're so large and so well diversified. So we tried to figure out a way that we could make that work for us as a smaller fund. And to show you some of the data that we used to back up that decision, there's just two charts I want to show you here. This is based on 600,000 transactions that we've analysed over the last 2 to 3 years. And we've also analysed the returns of about 700 VC funds. Let's start with the right-hand side chart first. This is basically 742 funds outlaid on a graph. And what you're seeing here is basically the returns, the 10-year returns on the y-axis here. And on the x-axis, you've got the number of investments that have been placed out of that fund. And what you can see here is a very sort of clustering of returns around the 0 to sort of 2.5x area. And that's where about 75% of funds end up in that area, unfortunately, because those are not great returns. That green line as a reference point there is NASDAQ. So when we analyze this, we found a very interesting correlation here between the number of investments that a large fund will place and the predictability of the returns. And as you move towards that y-axis, you see that the returns go down on a median basis. Whereas as you move up, when you move across the x-axis and you see the number of investments placed, the returns become far more predictable. And that accounts for why people generally prefer to put their money into a large fund, because they just know that there's going to be a lot more investments placed in there and that the power curve effect is more likely to kick in for those large funds. Now, some small funds, we all know that there's some very famous small funds that deliver fantastic returns. That's not really consistently available to most small portfolio managers. It's very, very hard to generate those kind of returns from a small portfolio. Just anecdotally, you'll get a unicorn every 100 externally funded companies feeding into that portfolio. It's probably a 1 in 100 selection ratio. So it's a 1% times 1% likelihood that you're going to get that kind of outcome for a very small portfolio. So if you have a portfolio of 20 companies and you're wondering why it's underwater, the chances are that you were unlucky. You really missed out on that 1 in 100 power curve effect that could have transformed things. And this is really illustrated graphically in the chart on the left-hand side here, where what you can see here are the results of about 4 billion virtual portfolios that we've built over the last 2 to 3 years. And you can see very graphically, say the third line in, just to select one line there, that this is a portfolio of 100 investments. And you can see if you look at the y-axis here, now what we're showing is the likelihood that the returns are going to exceed the return outlined on the x-axis. And if you see here, that red line, the third line in, this is fascinating. Basically what it's showing you is there's a very, very small chance. There's maybe a 20, 25% chance that you're going to get that 2x return. So this explains a lot of what's happening in the chart on the right-hand side. Now, if you go upward from that 2x up to the top of the blue line there, you can see now you have a high 90% chance of getting a 2x return. Your mid case becomes a 4x and your top case becomes an 8x plus opportunity. This fundamentally transforms things and explains why we believe why a lot of these large companies and these large funds do very well, simply because they just have a lot more a lot greater chance of catching some of those big fish in the net, to put it that way. So this is our strategy. It's a strategy we're following where we're creating this very, very large scale portfolio. What we're doing also is we're using technologies to enable this to happen systematically. So we've invested several $1 million in building a portfolio management system that goes all the way from identifying early stage companies to managing those portfolios through to maturity and through to the exits. A lot of what we've done has been informed by systems that we've viewed that are being used by private equity companies, public equity trading companies. And what we've tried to do is create a robust way of building that portfolio, analysing what's in the deal flow, and then managing it. And really the outcome of that is that we're able to scale deal flow to extraordinary levels. Last year, for example, we looked at 10,000 deals through our system. We're able to also standardise a lot of the documentation and due diligence that we use to a point where we can do a deal a day instead of a deal every couple of months. This also enables us to scale. It also enables us to stack various fund strategies. Most venture funds operate in series. So you have fund one, and then you do get that up and running, and you do fund two and fund three. We can actually co-manage various funds on behalf of corporates or other people that want to co-manage with us based on this stack fund strategy, because we have such an ability to scale and manage. And the final and probably the most important thing that we're doing here is we're really creating an opportunity to generate smart beta. Because of the size of the portfolio, we have a pretty good idea of where the returns are going to end up here. So this becomes a smart beta strategy. And if you want to generate alpha, you can jump in and you can cherry pick deals from our portfolio on a zero fee, zero limit basis. So it's really a combination of smart beta, but also enabling the upside. So the last thing I wanted to talk about is the fact that our deal origination network really does span the world. We have a fantastic network of people that are feeding us deals. So this is a great opportunity to jump in and look at what's happening around the world through our eyes and through the platform. The platform's available in 18 languages. It services 50 currencies. So it really is a worldwide global opportunity to find co-investment deals. So if you'd like to invest with us, please go onto the platform here, learn more about what we're doing. We'd love to have you talk with us and share more data with you about what we've learned. This is just literally the tip of the iceberg of what we've found through our last 3 years worth of investment.
Thanks, John. Next to present today is Moscar Capital, a venture capital fund managed from London, who targets smaller bootstrap companies with valuations ranging from 2 million to 10 million pounds. The growth in these companies has been harnessed by the ambitious founders who share their objectives to build compelling financial and societal returns. Here to speak further to this opportunity is CEO Leo Davis.
Hello, my name is Leo Davis and I am co-founder and CEO of Moscar Capital. Moscar is an established venture capital fund managed from London, investing in under-the-radar companies looking to grow exponentially. We specifically target bootstrap companies with valuations ranging from 2 to 10 million and take an active role in positioning them for a Series A. Tim and I formed Moscar in October 2019 off the back of a string of successful direct investments that have since exited between 3 and 8x over a 3.5-year period. After receiving feedback from our investor base, they wanted more of a structured co-mingled product, so we launched a British Virgin Islands fund alongside an onshore FCA-regulated investment manager. Since launch, we have invested in 4 companies, and I'm pleased to say our portfolio is performing exceptionally well, and we are conservatively up 100% to date. This is why we are now targeting a 5x cash-on-cash return to investors over the life of the fund. So what do we look for? When sourcing companies, we have 4 fundamental criteria that we rarely deviate from. The main reason being is that it's worked for us historically. but it also allows us to be non-sector specific and significantly reduces the risk of failure compared to that of a seed stage fund. Because we can't be experts in every industry, we look for other indicators that can validate a business. A minimum revenue level of 500k shows me there is a market demand for the product or service. We check that customers exist, that they are happy with the product, whether they'll be renewing their contract. We also look at pipeline because this shows us whether there is a growing demand. A bootstrapped cap table shows me that the founder is truly integral and heavily invested themselves. It illustrates that they can grow a company on a shoestring by investing their own money or friends and family money very carefully. And it also shows that they can manage growth by issuing equity sensibly. Running at a small loss or profit is important because it identifies the start of the company's next stage growth cycle. A low cash burn means our investment can be used for specific growth objectives, i.e. for CapEx, and not swallowed up for short-term OpEx. It proves to us in numbers they are not relying on investment capital for survival. So by simply shortening an investment cycle in this asset class, you are immediately taking some risk off the table. And if we can't position a company for a Series A within 18 months, it won't fit our mandate. A constant stream of cash realizations also gives great value and confidence to our investors. So our criteria makes us unique in targeting a specific stage of growth. The problem with sticking to these core criteria means that these companies are hard to find. But we've built up an extensive network over the years, and so they know to bring a unique set of deal flow to us. We're not looking for perfection in these companies by any means, but what we're looking for are emissions that are easily fixable, where we can identify a clear return on investment. These emissions are often due to lack of smart capital, and this is where Moscar adds value. Ultimately, we invest a lot of time, expertise, and experience because founders often don't have the skills or knowledge to provide an institutionally watertight offering. So it's our playbook that readies them for larger institutional funding. We assist with board formulation, business analysis, establish live accountancy and CRM systems, bank account oversight. This gives us complete transparency of the company's position. So if something isn't working, we can address it immediately. One of our portfolio companies, Ethical Angel, is a good example of our value add. After helping them close a new round at a 50% higher valuation, we were successful. We were able to tag on a successful application to the government's future fund. We feel we add most value pre-Series A. The downside with Series A or later is that most of the upside value has already been created. Therefore, our value add dovetails perfectly with our criteria. We have no limitations for sector concentration, which allows a focus on the quality of the deal rather than having to source a deal to fit with portfolio requirements. Our headline investment, Suburb Deliveries, is a premium on-demand delivery for high-end restaurants for the likes of Zuma, Scott's, Sushi Samba, Rocker. They fill a gap in the market that Just Eat or Deliveroo cannot. Or more importantly, these are restaurants who don't want to use such a low-end service for fear of damaging their reputation. Supper's annualized revenue was at 800k when we bought in. It has now accelerated to a very impressive 13 million. Near Street is a retail tech firm that connects high street stock to Google. They have created an API that aggregates over 1,000 existing inventory systems. For example, let's say I want to buy a specific pair of trainers. I can search for it on Google and my online options will be listed. Near Street will automatically list the closest geographical location of that trainer on the high street. Great impact business, boosts high street shopping and will influence a new trend of shopping since COVID and beyond. Demand for their service has increased by 6x in the past 3 months. Square Root Soda is a premium craft soda company, low sugar, high seasonal fruit content, no avoiding that they have been hit by the pandemic. However, they successfully pivoted to B2C and they're already starting to receive B2B orders since restrictions have eased and are exporting to France, Italy and Germany. They have close ties with Brewdog and are looking to leverage this relationship to expand their international presence. Ethical Angel is a social impact company. They have built an intuitive desk-based volunteering platform that connects charities with corporate volunteers. For example, let's say I'm a web developer at IBM and WaterAid require my skills. Under my employed contract with IBM, I'm seconded to WaterAid for an hour or so per week to fulfill their requirements. So as a volunteer, I feel great about my charitable self. The charity has their work done at no cost. IBM have implemented something proven to retain staff whilst at the same time boosting their own CSR. And finally, Ethical Angel are remunerated together with the opportunity of expanding their licensed user base. For example, Barclays have requested an additional 15,000 licenses since completing their trial period. So we're looking to add at least one new company to our portfolio each month. So here's what we have on offer. Investment level starts at 25,000 sterling. The maximum life of the fund is 7 years. However, we are aiming to exit our portfolio companies within 18 months of our investment. So there will be a steady stream of cash realizations where the investor has the option to take their profit. Our fee structure is a standard 2% annual management charge and a 20% performance fee with a hurdle of 7. We are already ahead of target, which is why we're aiming for 5x. Finally, as a rare non-seed stage VC fund based in the UK, we believe we have a highly compelling opportunity for an international audience. These companies are in a perfect position to capture the new economy. Anyway, thanks for watching, and do please engage directly for any questions you may have.
Thanks, Leo. Up next to present is Zelwin.com, a global marketplace of goods, combining both e-commerce and digital assets. Two fast-growing markets. The products listed on the platform are ready-made, paving the way for mass adoption. Here to discuss this further today is CEO Nicholas Gilef.
Hello everyone, my name is Nikolai Shkilev. I'm CEO of Zelwin.com. What is it, Zelwin? Zelwin is a global marketplace of goods where we combine digital assets and e-commerce together. Everyone can buy on our platform any goods by traditional money or cryptocurrency online. And huge advantage of our platform that for every purchase, our customers get guaranteed Zelwin tokens, and they can to exchange these tokens to other cryptocurrencies, to dollars, to euros, send to Visa, to MasterCard, or save them up. We only launched in April of 2020, but we received and achieved a huge progress and big traction. For example, we have more than 600 partnerships. We have a community in more than 20 countries, and we are already listed on 5 exchanges in top 20 by coin market cap, like Bitforex, CoinsBit, Probit, Hotbit, and DigiFinex on top 20. And our price started at $1 per 1 Zelwin token, but now our price more than $4 per Zelwin token. It means that early investors received more than 325% of ROI, return of investments, and we are growing. Why we are growing so fast? I have a big experience as owner and as investor, and more than 20 years of owning different types of businesses, as well as you, I think. And we understand that 98% of all IT, blockchain and startups have 4 main problems. Problem number 1 with the ready-made product, usually it's only an idea. Problem number 2 with clear business model. Problem number 3 with mass adoption, and problem number 4 with financing. We resolved all of these problems. We have ready-made product. 11 teams worked on this powerful project. It's IT and blockchain experts, lawyers, economists, marketers, designers, etc., etc., etc. We fully financed the project. We did everything using our own money. And number 3, we have mass adoption because more than 2 billion people buy goods online. And we have a clear business model because we have no less than 4 monetization methods. For example, it's traditional way of monetization. We receive money from customers and receive commission from merchants. Number 2, we have exchange on our platform. You can change fiat to crypto, crypto to fiat, and we receive commission from both sides, of course. Number 3, we have a powerful affiliate referral program where everyone can earn with us. For example, the people can invite merchants to our platform and receive commission from all their sales. People can invite buyers to our website and receive 20% of their cashback. And it's profitable for buyers too, because if they use a referral link, they receive a cashback in 2 times more. For merchants, it's profitable also because registration is absolutely free for them, no subscription fees. They pay only commission from real sales. It means 0 risks for them, and it's additional sales channel. And we also have VIP packages on our platform for our partners, and people can invite other partners to our platform and receive commission up to 30%. In other words, we're developing a marketplace for the people. Everyone can join, everyone can earn. It's win-win strategy for all parties, especially because COVID-19 and a lot of millions of people will be left out from job, and for these people we can provide a job. It's absolutely free and people can earn money with us. By the way, why we're growing so fast, also I must explain it. Before our launch, we didn't make any ICO, IO, airdrops, etc., etc. That's why nobody can kill our price now. We are growing without any pressure. And today I want to make an exclusive offer to you. We have different packages with different discounts. For example, you can buy digital assets of Zelwin for $1 million, and you will receive 15% discount for our tokens, and you will receive additional bonus from us. We will provide announcement in our Twitter, in Telegram, in Instagram, in Facebook about our partnership, about your company, and we will do it every month. We will provide 10 articles about your company in different media, including entrepreneur.com, etc. Also, we will do 150 stories from bloggers in Instagram about your company and our partnership. We will put your logo on our website as a partner. Also, we will provide your logo in all our marketing materials as a partner, etc., etc. So, I invite all of you to become our partner. Let's create a new giant together. And here you can see my email address, my Telegram, my WeChat. You can send to me any message. Thank you for your attention. See you soon.
Thanks, Nikolay. Our next presenter is Alpha 7 Energy, a privately owned energy company which is primarily focused on developing early-stage, top-decile conventional and unconventional oil and gas reserves in the United States of America. Peter Fagan, Grant McLaughlin, Dylan Knight will now jointly describe this opportunity in more detail.
Hello and welcome to an Alpha 7 Energy presentation. My name is Grant McLaughlin and I'm one of the senior partners within the organisation, and I'd like to introduce you to...
Hi, I'm Dylan Knight, the co-founder and one of the senior partners.
And I'm Pete Fagan, an original investor with Alpha 7 Energy and now a senior partner. I'm based in Sydney, Australia.
Yeah. Now, Alpha 7 Energy, best known as ASE, is an international energy corporation established back in May 2017 with our HQ in Dallas, Texas, and an office located within the CBD of Sydney. ASE offers direct oil and gas ownership model, which is fully managed and is structured to generate monthly residual income. Now, we do have a special announcement to make, and this is the first time we've officially disclosed this information to the general public, and Pete will explain more later.
Thanks. Now first, due to the pandemic, global production levels have been cut significantly. The natural decline curve in operating wells, restricted investment capital in new projects positions Alpha 7 Energy with low completion costs with significant upside potential as the world oil demand increases.
Since COVID-19, the oil and gas industry in the US faces many challenges, such as 85% of companies having to close in their wells due to these low oil prices, or even worse, file for bankruptcy. A lack of Wall Street funds made available to oil and gas companies for future development, and perhaps the most telling fact is the current active rig count throughout the US dropping to 185 rigs, down from 788 at this time last year.
Now, during the past 6 months through 2020, we've seen some of the toughest global conditions seen in decades. ASE has been able to absolutely flourish. This is because we carry very little to no debt, offer an equity-based model for investors, and have low operational costs. In addition, up to 90% of the whole ASE team has ownership in the company and skin in the game regards physical projects and wells we invest in. And also we invest alongside our investors, so our interests are fully aligned.
Alpha 7 Energy has achieved a number of major milestones in the last 12 months, having acquired a 24,000 acre lease from billionaire the late T. Boone Pickens. We've drilled multiple wells on multiple leases. We've purchased 2 drilling rigs at the value of $8 million, and we're looking to acquire additional leases in South Texas. This ensures we have sufficient projects in our pipeline for our investors.
Up to 90% of global investors lack diversification within their investment portfolios. Most investors have been programmed to stick to property and, of course, the stock market. Investing in direct ownership in oil and gas wells not only diversifies one's portfolio, but it allows investors to earn US dollars on a calendar monthly basis for every project you have an ownership in. As ASE develops out multiple oil and gas leases over the next 5 to 7 years, investors have the opportunity to build their own oil and gas portfolio with the team here at Alpha 7 Energy.
Now, over the past 3 years, we have perfected a proven pathway for non-US resident investors to access exclusive oil and gas projects located within the United States. Each investor has shareholdings in the individual phase of the project through a special purpose entity and receive direct asset ownership in the wells in those facilities. This generates a monthly residual income through the sales of oil and gas for the life of each well.
We have a lower risk business model offering investors direct participation in oil and gas assets. Investors are our partners on the project and therefore hedge out company risk. They benefit directly from oil and gas sales. Now, project selection is a critical part of the process. We target proven oil fields that are underdeveloped, and all projects are fully vetted by independent third-party expert teams.
We have 2 models, our most popular and profitable being direct oil and gas ownership. This provides investor partners with monthly residual income through oil and gas sales, with the average estimated return on investment of between 500 to 700% over the life of the well. Our second option, an asset-backed oil and gas equity builder. This gives the investor partner event repayments through our drilling program. The initial investment is fully secured against our equipment. with an estimated return of investment of between 122 and up to 300%.
Yeah. Now, by investing directly at the source, known as a working interest, the investors create diversification within their investment portfolio and receive the ability to generate the all-important residual income, which is paid in US dollars for the life of each well, or receive a lump sum payment upon the 5 to 7 year exit strategy. The way that we structured these direct ownership model is to give access to the investors some of the most attractive tax benefits found globally.
Now, the major highlights proving up our lease in Seminole County include drilling multiple wells back to back, reaching target depths on all wells, discovering 2 additional pay zones, securing additional acreage in the area, and as Grant mentioned earlier, we're happy to report for the first time that we've discovered the Meisner formation on our lease. The investor production expectations on these wells were 50 to 70 barrels per day. Based on petrochemical drilling logs, we have the potential to produce hundreds, if not thousands of barrels per day on these wells.
Yes, we do.
With the global pandemic in the first half of 2020, Alpha 7 Energy was presented with an opportunity to purchase 2 drilling rigs. The first rig is geared towards the drilling of our shallow wells to a depth of around 4,400 feet in Seminole County, Oklahoma. And the second rig is capable of drilling deep horizontal wells, the likes of ExxonMobil and BP drill, which can be as deep as 10 to 12,000 feet, with horizontal legs of also 10 to 12,000 feet. We were able to acquire these rigs for 15 to 20 cents on the dollar, thus allowing ASE to offer this asset-backed, fully secured investment opportunity, which is ideal for the more conservative investor with a lower risk tolerance threshold.
Yeah, to the best of our knowledge, ASE is the first to offer this type of investment structure within the oil and gas direct ownership space. It is designed to allow investors with a low risk appetite to have their investment secured against physical assets. The repayments are event driven and not oil based production driven. Yet, this is the kicker, having direct interest paid in oil and gas ownership, thus creating an opportunity to receive monthly residual income for between 20 to 50 years. And that's after the principal has been repaid.
We're proud to offer and support investors through a due diligence process. This instills confidence and assurance that all bases are covered and investors have the information needed to make a fully informed investment decision.
As a new investor partner in any of Alpha 7 Energy's projects, you will receive full access to our investor portal for every project you have an ownership in. You get access to our 24/7 live camera feed during the drilling and completion of each of our wells that you have an ownership in. You get an introduction to our Dallas-based attorney to set up your US company, which is your LLC, a limited liability company, as well as access to our contacts at Prosperity Bank to open up your US personal business banking account, which will receive investors' monthly income.
Now, 2020 has been a year that most people will never forget, yet ASE has truly been a flourish through these challenging times, and the momentum is building with multiple projects and opportunities in development. For the remainder of 2020 and beyond, we will continue to drill another 7 to 10 wells at Seminole County, Oklahoma, secure more rigs and equipment, and continue to drill out multiple wells at the famous Mesa Vista Ranch and our soon-to-be secured String of Pearls project in Texas. ASE is perfectly positioned to maximise the opportunity created by COVID-19 and the massive shift in the oil and gas sector. ASE and our investors' interests are strategically aligned, which mitigates risks and also optimise the individual project's return on investment. As we mentioned, we have 2 investment models which suit most investor types with multiple opportunities which ASE investors have the first right of refusal. We do target returns of between 133 up to 700% on a per project basis. Now finally, for all qualified investors that have a minimum of $75,000 to invest for a limited time, we're offering a personal presentation for you to come into our Dallas or Sydney headquarters or do a Zoom meeting where you can see the physical evidence of the well logs of the ASE 1 and 2, the Holy Grail, the Meisner, see the revenue calculator and other key information and truly understand the vision of ASE, more importantly, the direct benefits for you as an investor. We look forward to connecting with you soon. My name is Grant McLaughlin.
Thank you. I'm Dylan Knight.
And I'm Pete Fagan.
Thank you for your time.
Thank you. Thank you.
Thanks, guys. Next to present today is Forevercorp. a specialist investment manager establishing itself as the world leader in diamonds as a new form of alternative assets investment. Forevercorp will be launching the world's first wholesale investment fund, providing sophisticated investors with access to a professionally managed portfolio of investment-grade diamonds. Here to talk further about this opportunity is Steve McDonald and Harry George Bodekian.
Hi, I'm Steve McDonald. I'm the CEO of Forevercorp. My background is in investment management. I was a senior portfolio manager at BT Financial Group, where I managed almost $1 billion of client money. Previously, I worked for a long time with Macquarie Bank and traded commodities, and I've run my own investment management business, which I exited after 8 years in 2016.
And I'm Harry George Bodekian, Head of Investment for Forevercorp. I am a gemologist, a diamond grader, and accredited master jeweler by De Beers. I have been in the industry for almost 40 years and played with a lot of diamonds, as you can imagine. So, and I am very, very passionate about diamonds, especially investment-grade diamonds.
Forevercorp is a specialist investment manager in the field of precious gemstones and metals. We're bringing professional investment management to what's been a traditionally opaque and difficult market for investors to access. But we're bringing the skills of professional investment management to this asset class.
People often ask me, do diamonds grow in value? Well, I can tell you today, major auction houses such as Christie's, Sotheby's are achieving and breaking records of fantastic high prices per carat for diamonds, for investment-grade diamonds. I can also tell you my own personal experience. Some 30 years ago, I was offered a 1 carat vivid pink diamond, round diamond, for around 100,000 Australian dollars. Today, the same diamond you'll be achieving around $1.5 million in price, Australian dollars. Apart from Argyle pink diamonds, there are other investment-grade diamonds, African yellow diamonds, blue, pink, green, purple, and the rarest of them all are the red diamonds.
Investment-grade diamonds fit in the category known as alternative assets, like gold. It's very important for investors to have a safe haven asset like this that diversifies their portfolio and has low correlation to other investment markets. But not only are they a safe haven, they're also very well performing. Returns from investment-grade diamonds over the last 15 years have outperformed all other investment types, including the Nasdaq, property markets, and gold. We expect that that's going to accelerate in the near future. Huge amounts of money are being printed all around the world through quantitative easing, and that money is looking for investment assets of high quality. This is occurring at a time when supply of investment-grade diamonds is about to fall off a cliff. The Argyle mine has supplied 90% of the value of investment-grade diamonds, and that mine is scheduled to close later this year in 2020. We're calling it a perfect storm.
How does someone buy an investment-grade diamond today? Well, by design through the diamond industry, most people only have access to retailers. And when you actually buy an investment-grade diamond from a retailer, basically you don't really know the right price and the right value of that particular diamond. And then, with no consideration, is how to sell the diamond. Most people also will buy diamonds through emotions. And this is where we take all the emotions out. We only go after investment-grade diamonds that perform extremely well. And this is the key difference for Forevercorp.
Forevercorp is professionalising investment in this asset class and changing what has been an opaque and difficult market to access with an imbalance between the buyer and the seller in terms of knowledge. We're putting professional investment management at the disposal of investors. We're sure it will create a very successful investment management business. We've successfully raised around $500,000 of seed capital, and we've developed a suite of services and products to take to a global market of high wealth investors. We are seeking a further $2.5 million to undertake what we hope will be, what we plan will be, a really successful high-grade education and marketing campaign to bring awareness of this to investors around the world. The size of the market is huge. It's got a lot of similar characteristics to gold, but a number of advantages over gold. But if we can capture just 1% of the amount that's invested in gold ETFs, we would have a business with billions of dollars under management. It's an exciting opportunity. But this money that we raise will see us through to profitability. We will not be coming back to investors again. It's a once-in-a-lifetime opportunity to access a company that is pioneering what will be an exciting new form of investment. It's going to be exciting. We're sure it's going to be successful, and we'd like you to join us.
Forevercorp. Investment made beautiful.
Thanks, guys. It's my pleasure to now introduce keynote speaker Alicia Lycos, CEO of Red Wolf Group, who will be providing us with insights around building a high-performance team.
For years, the talent side of your business has been like a mystical dark art, often delegated to HR. But our framework really enables you as business leaders to own the conversation around people, but also have confidence, capability, and also the data so you can have a more effective conversation at that executive level. Business leaders are equipping themselves with more data than ever to manage and grow their businesses. Yet when it comes to the people side of your business, your talent costs, these are often more than 60% of your P&L. Yet this is the one side of your business that is often left to chance. It's the thing we're gambling on, and we use our gut instinct to make these large decisions. At some point, you have to ask yourself, when the bottom line's at stake, how much risk are you willing to take? If people are the most valuable resource in your business, it's only right that you start to look at the data and the reasons behind what drives and motivates them. The methodology of talent optimization is really built on having accurate and insightful data around your people. We do that through the Predictive Index, which was established in 1955, and since then their behavioural assessment has been through over 350 validity studies. It's used through thousands of companies around the world, and over 28 million people have taken a behavioural assessment. The Predictive Index behavioural assessment only takes 5 to 6 minutes to complete, and it can be done on your mobile device, making it really quick and easy for both the candidates and the employees to complete. The wonderful thing is these reports are rich with information, but are also really easy to understand from an employee's and manager's perspective. The thing that I'm always amazed at is when we go through people's results is they always say, I can't believe you got this amount of accuracy from such a quick assessment. Today I want to introduce to you talent optimization, a new framework and discipline that allows you to finally align your talent strategy with your business strategy. The first step of talent optimization is design. For business leaders, having a very crystal clear strategy is really critical to your team's success. But not only having a great strategy, you have to make sure your team is aligned on that strategy. You're all heading in the same direction. To achieve that alignment, we have all members of the executive team take a strategy assessment through the tool. And then we run a workshop to have a look at, well, do we all agree on that strategy? What are the key priorities? What are we going to proceed with? And then let's overlay the executive team's profiles to really understand their strengths and their drivers, but where they're going to be best suited to play in that executive team in relation to the strategy. We can then start to look at who else in the business could we bring in to help us deliver on these key objectives. Often I hear business leaders saying their key priority is getting the right people into the right roles. We help you do that through the tool by building the jobs and having total clarity about what you expect of that position and what's the nature of the job. We have multiple people take the job assessment so we can clearly see how well aligned they are on the expectations of that job. Once we do that, we can have a look at the job report and we can read really clearly what's expected of that position. What are the behaviours required? What's the nature? What's the day-to-day type of activities, their communication style? We can take some of that wonderful language and put it in our job ad because we know scientifically we're therefore going to attract the right people to our job. When candidates submit their CV as a part of their application process, they're also going to take the Predictive Index Behavioural Assessment, which only takes 5 to 6 minutes, and they can do that on their mobile device. The benefit of this is that when you go to start screening your candidates, you can have a look at not only their CVs, but start having a look at their behavioural profile and how well aligned they are to the position. You can even download custom interview guides for each candidate in the software so managers can validate and ask more powerful questions during the interview process. Once you've got some preferred candidates in mind, you can even start to look at how they might impact your team dynamics using the Team Work Styles tool. This is a really powerful way to have a look at your candidates in comparison to the rest of the team, and again, predicting how they might impact and really benefit the team. With Predictive Index, you can better understand yourself, but also others to have more effective and powerful relationships. We have the 17 reference profiles, which is a great and easy way for others to learn more about each other and how to work best with each other. In a few short clicks, you can see how two individuals in your business can work together more effectively, some of their cautions, but also some of the tips. Or you can dive into how your team works together, how they communicate, take action, or even make decisions. You can help others inside your team better understand each other using some of these really powerful visuals. We all know a one-size-fits-all approach to management doesn't work. The power of PI is that you learn how to adapt your management style for each and every member of your team, how they like to be managed and communicated with. So these powerful management strategy guides really give you those quick insights. There's 12 things here, but these are different for each person in your team, really making sure we can create really effective and efficient managers at all levels. Through the personal development chart, we can really work with individuals inside the business around not only what their strengths are, but how their cautions might play out. There's some really helpful coaching tips here as well for managers to walk through with those employees. Often employees want to explore different career paths inside the business. Now, once you've had a chance to go through and profile all the jobs in your business, there'll be an option for other job matches. So you can sit with an employee and work through with them about what other positions they might be suitable for based on their behavioural drivers and the drivers of that role. If you've transitioned somebody into a new job, there's a really great coaching guide which has a look at that person's profile against the profile of the job with some really great powerful questions you can work through with that employee around what are some of the caution areas and what they might need to do to adapt to that position. It's important that we can really measure what's going on in the business and that we're moving the dial on some of these things. So therefore, we've created an employee experience survey that sits inside the tool so you can really get the pulse of the business, find out how people feel about not only their job, but their manager, their teams, and the culture of the organisation. You can then break that data down into the teams and divisions inside your business and give managers an opportunity to reflect on that, but also walk through some of the take actions that are inside those guides. We run a workshop with your managers so that ultimately they own their own results and they own the actions that they need to take. We're really trying to increase the accountability that sits inside your business with your managers. This isn't just about the executives driving this change, but about managers owning it and really knowing what they need to do to make improvements. Our model is structured on 3 things. 1, predictive index and giving you access to the software to do all these incredible things. 2, manager education and training, and 3, strategic advisory and ongoing support. Predictive Index is unlike anything else. This isn't a pay-per-assessment model, which you might be more familiar with other providers. When you have a pay-per-assessment model, it usually means you only offer it to your executive teams, or you might wait to the very end of your recruitment process. We find this style means you really hold back and you're selective in who you choose to put through that process. Predictive Index believes that we should create leaders at all levels, and that means that we have to be able to provide this great self-awareness to all employees at all levels. That's why Predictive Index is an annual subscription model. It's based on your headcount, and then it's unlimited use, so you can use it for all employees, all candidates at all levels. The second thing is training and knowledge transfer. It's not about us doing it for you, it's about your managers feeling empowered and that they can take this information from Predictive Index and really start to apply it, from being able to recruit the right person into the right roles, to understand their team dynamics, to motivate and inspire their individuals, and ultimately be better leaders for their teams. We do that through a 2-day workshop, and this is all about making sure that they can walk away with this information and know how to apply it. The third thing is ongoing support, services, and advice. We're here as experts in talent optimization, and we really want to make sure that you're successful with this, so that everything we do is about understanding you and your business. What are your priorities and what do you want to achieve? And we help you build that roadmap so you can go out and achieve that. I hope this video was helpful to you and your teams really understand what we do here at Red Wolf Group, and help you really understand the science behind workplace behaviours and how we can help you drive talent optimization through your business. If this has sparked some interest to you and you want to find out more, then please reach out to me on the details here provided, and we can have a discussion about you and your business, your priorities, and what you want to achieve, and how we might be able to help you achieve that.
Thanks, Alicia. Next to present today is Zupply, a cloud-based suite of software and apps that simplify core operational processes for the food, wholesaling and retail industry. The Zupply solution has been successfully tested and piloted for 6 months, used in the processing over $400,000 in weekly sales volumes. Here to dive deeper into this opportunity is CEO James Kelly.
Hi, I'm James from Zupply. Welcome to the presentation. Zupply provides a suite of software and mobile apps to simplify core operational processes for the food, wholesale and retail industry. For wholesalers, Zupply provides solutions to all their operational challenges. For retailers, we provide them with an online e-commerce solution to compete with the market chains and other bigger grocery stores in their geographic area. The issues. The age-old process of fresh food supply is not for the delicate, with overnight operations 7 days a week. The process is labour-intensive and fragmented through client requests and requirements. Processing and dispatching a high volume of orders within hours of the market's opening, whether it's seafood, meat or fresh produce, is a significant challenge, whilst ensuring all customer requests and requirements are adhered to, take experience and skill. Some of the challenges involved in this process include multiple order channels make it difficult to manage order compilation, customer requirements must be communicated through the process, and pricing agreements must be adhered to. Perishable foods have significant stock control measures, and chasing payments is biased to the outlets rather than the supplier. Current e-commerce solutions can't handle the fast-flowing cycle. Problem deep dive. The wholesale food industry is in the digital transition process. The hospitality industry has led this change through their engagement with digital POS systems and digital inventory and ordering products. Wholesalers need to both offer this client base a digital ordering facility and at the same time reduce their operating costs through digital automation of repetitive manual tasks in order to stay competitive in their cost to serve. Supply provides these functions to our clientele, effectively digitising their businesses, creating a very sticky customer, giving a significant lifetime value of customers to the Zupply platform. Supply ingratiates itself in the wholesaler's business by solving their operational challenges and at the same time reducing their operating costs. This will enable Zupply to execute the following key revenue drivers: automate payment collections, introduce a platform fee collecting on all sales on the platform, continue to play nicely with other market players through our connector product, and build out further financial products including buy now, pay later and debtor financing, and ultimately unlocking the supply chain finance that is currently locked up in the industry as a whole. The Supply suite. Supply has four main products, being Supply Premium, Retail, Grow and Connector. Premium is a significant business management tool for wholesalers. We currently, on average, save up to about $150,000 per year through automation and integration. We do this by driving efficiencies in the day-to-day operations, particularly in the following areas: real-time reports for the team to do work, reduced labour hours in data entry of orders, live inventory systems, warehouse product location and features, reducing packing times, and run allocations and delivery logistic features within the platform. So a quick overview of how that works. The orders come in through shops into the warehouse platform and dispatched through the day. Supply Retail is another product on Zupply. Supply Retail specifically caters to the traditional food retailer, being fruit shops, butchers, seafood wholesalers and grocers. We link a full e-commerce solution to their existing website, enabling an online shopping experience for their clients. Competing with the powerful grocery chains is key to the future of the offering of these traditional retailers. Just some images of our apps. Supply Payments. All payments for orders will be securely processed on Zupply. For every transaction made on the Zupply platform, a small percentage is taken by Zupply, similar to Shopify and their payments module monetization. We're currently designing further market-leading payment features in regards to unlocking the supply chain finance within the industry. Connector. Connector is breaking serious ground for Zupply. Other industry players are now actively seeking the use of our product to maintain their own relationships within their tech ecosystem outside of the Zupply platform. Connector enables Zupply to build strong partnerships with the industry as a whole. Just a quick overview of our current customers. We've got here QuickSys. They've been around for a while. Their tech is getting older and older and they don't seem to be able to keep up, and we're taking customers off them regularly. Automentum is predominantly focused on bakers and coffee merchants and solving their problems. And Fresho is probably the closest one to us, who are a little bit ahead of us, but they don't solve the back-end challenges that Zupply does for our wholesalers. Market size, just on a high level, on IBIS World this year, they report cafes and restaurants at about 40,000 nationally, with about 22 billion in trade annually. And as a whole, the fresh produce sector generates about 32 billion in annual revenue. And Sydney markets, where we're based, is home to over 137 fruit and vegetable wholesalers and 400 fruit and vegetable growers. Supply is highly scalable for the next expansion phase to other key markets within the eastern seaboard of Australia. Key clients and partnerships. Zupply product has successfully tested and piloted for over 18 months with some significant wholesalers on the platform, with an existing customer base of 15 wholesalers, listing over 23,000 inventory items and processing over 400,000 in weekly sales volumes. Our customers are established businesses and we work closely with them to keep continually improving our product. The team, Adrian and myself, designed and co-founded Zupply. We did that in 2013, and since then we got to market about 2016. And since then we brought on Chris, Kevin and Danica. Chris is the real owner of Zupply and the development. The ask, Zupply is looking for investment of AUD of about 2.8 million over the next 3 years to continue building our market share within the industry. This is a consideration of industry annual turnover and outlets within the target market segment, the cost of customer acquisition, and the lifetime value of those customers to the Zupply platform. Milestones that we're looking to set KPIs against over the next 2 financial years. This year we'll be introducing the per order revenue. The in-app advertising revenue should start to kick through. The connector revenue is already taking off through, as mentioned before. And for the BDMs, we need to onboard wholesalers by the end of 2022 to reach our turnover of 100 million annually. And daily hospitality users, 2,000 per week by the end of this year. And obviously, as mentioned, it's discussed, monetize the payments platform by the end of this year or early into the next financial year. The distribution of funds is basically for additional hires to flesh out our teams. The development team always needs support as the product gets bigger, so we're looking for a DevOps developer and a front-end developer to keep the user UX best in market. The sales and marketing, this is where we need to concentrate now. The product's really built, we need to really focus in on sales and marketing. So we need an operations and sales and marketing executive and flesh out the business development team by 1 to our additional team. And obviously we want to apply some budget to our marketing and sales strategies. So at a high level, just the investment summary. The product is developed here in Australia by us, by our team, and has IP protection across certain parts of the world, including the UK and US. We have proven product market fit and is rapidly growing the customer base, which is our key strategy in the next 12 months, and favourable market dynamics to capitalise on the industry changes in the essential food and produce industry. So thank you for coming and enjoying our presentation. I hope to speak to you soon. Thank you.
Thanks, James. Our next presenter today is Long Pipes, which has made the world's first seamless, continuous and smart composite pipe labelled the Fluid Highway. After a string of notable achievements and explosive traction, Long Pipes is presenting this venture to wholesale investors. Director Neil Graham will discuss this offer in further detail.
Hello, I'm Neil Graham. I'm one of the inventors and a director of Long Pipes Ltd. We make pipelines around the planet for all sorts of applications. I always start with this extraordinary view of the world as seen through the eyes of a pipeline engineer. There are approximately 6 million kilometres of this stuff out there. Steel pipe. And as you can hear, it's rather heavy and outdated. Well, we're going to give you a tour of what the future for fluid transportation looks like around our planet. Long Pipes is a revolutionary change in fluid transportation. Here are all the details of it, but basically we change the way the world transports fluids. And we do so in a way that's never been possible before. We have enormous markets globally, and I keep putting down 11 billion a year, and that's starting to look smaller and smaller based on the projects that we're talking to right now. We talk about energy, water, etc., but our future depends on hydrogen. And hydrogen and the hydrogen economy are where we are going, and you can read the details of that in that slide. Basically, If we don't convert to a hydrogen economy in the next 10 years, we're in trouble. We think we're a key enabling technology to achieve that change globally, and we're working towards it. If I don't leave you with the impression by the end of this presentation that you are looking at a multi-billion-dollar global company in build, then I have failed. So please take the time to look at each of the slides individually and determine for yourself what your thoughts are on this, because for me, this is a global game changer, a transformational change, as our chief scientist, Alan Finkel, describes it. So what's our vision? To change the way the world transports fluids. Our goal is to become a global leader in the $120 billion a year business that is energy, water, and other pipelines today, but position ourselves for the future in the 15 trillion a year for infrastructure. The 15 trillion overall that is required in infrastructure for the change to the hydrogen economy. Why would we bother? The pipeline industry has been around for 5,000 years, since the pharaohs, but it's got real problems. It's got problems in transportation, it's got problems in safety, it's got problems in welding, it's got slow, it's got hundreds of people in field. Why would we change it? To eliminate all of those problems on that page. Our solution, a seamless, continuous pipeline network produced in field or in factory that's intelligent and it thinks. Yes, a pipe that thinks. I've done this before. I've owned two of Australia's largest aerospace companies and listed them on the stock exchange. So how do we do this? Well, we make up what's called a stock. Here is a sock. Made of fiberglass in this case, and we turn it into a pipe in the field once we've printed it using that machine. It enables us to create continuous pipes without joints for virtually any length of kilometre, 2 kilometres, or 1,000 kilometres. It wouldn't be any good if we were producing a pipe that wasn't any good. In this case, our pipes are the top in the world. There is nothing that's as strong for its thickness or even close to it in comparison to what ours are. We can customise them. We can make them in fiberglass or carbon fibre. And we think we can do 200 to 2 metres. This isn't just think, we're operational. Here's what the machines are doing in the field. This is what's going to happen. This isn't fanciful. This is a transformational change that is coming. The details are set out there. Basically, hundreds of people in the field down to 3 or 4. But it's more than that. When I said this pipe thinks, I mean it literally thinks. This pipe is intelligent. It has what we call embedded intelligence in it. Dumb pipes are now obsolete. You can read the details there. So we're continuous, faster, lighter, stronger, more intelligent. In fact, the only intelligent pipe, low labour, cheaper, all those things. Look down the bottom though. We believe we will be able to make hydrogen and hydrogen pipeline systems that enable us to produce pipes for networks and plants and chemical refineries, much larger than the conventional pipeline program, and enable us for something like Aramco to produce it for sour oil and gas. Where can we use it? All of those places. But look down the bottom, raw CO2 and hydrogen are the key technologies, the drivers for the hydrogen economy coming up. We're it. So we have our first US joint venture production company, or ProdCo. It's called First Catch. Unfortunately, I can't see you inside, but I can show you what we shipped. This is our printing press for pipe production, or should I say sock production. And this is our pipe production machine on the trailer. As you can see, we've gone from 20 and 30 crew down to 3. Distance is up from a couple of 100 metres to 2,000 metres. This is a revolutionary change. Not just our ideas on it. The US market has recognised that, and they have a problem. the price of oil has dropped. They need a cheaper way of doing it. So COVID-19 is the perfect storm that benefits long pipes. And it's a big benefit. It's a big market too. This is what we're looking at for the shale plays in the United States. And every single well needs a pipeline connected to it. So our first largest customer, there are two primary customers in the first block. Each wants 1,200 miles, or around $400 to $600 million coming up in this next year for pipes. There are 40 more customers waiting, and we give them this little test. This is what they're using at the moment, and that's about half the thickness of their conventional pipe. This is what they're going to, and they have a choice, black or white. They all choose white. So we have 40 customers who've already said we want this. It's about 13,000 miles of pipeline a year. That might sound a lot, but we've got 1.7 million wells to connect. That's going to keep everybody busy for many years. Even if they stop drilling, they still have to connect. These are the benefits that you can see. Basically, one's a hell of a lot smaller, lighter, cheaper to install, and is just simply much higher performance. These are the details of how much of an advantage we have over our competitors in the field, and they are just extraordinary. That's the reason why they all choose our pipe. But that's the United States. Australia, we're looking at working on West East, the Northern Territory, the new Northwest Shelf, which is actually on land, and the feasibility studies are expected to start shortly. We could actually have more pipeline requirements in Australia than in the United States. This isn't just an Australia or US issue. Shale gas production is going to take place all over our planet. We hold the keys, we believe, to that. Our biggest global market at the moment is the Middle East that's coming up, and you can see the projects that we're looking at for the Middle East program. Yes, there's a tremendous advantage in being based in the Kingdom of Saudi Arabia because they help you with all of the investment. But that's today. In fact, that's actually out of date. Now, today, our hydrogen market is our biggest market by far coming up. And as you can see, hydrogen, the hero, as Alan Finkel describes it, is the new fuel coming for our future. Here is the first hydrogen pipe. Yes, I'm the Goonie guy holding onto the pipe. Produced. Now, H2H no leaks is not a boast. If we can achieve that, we are the only pipe that we are aware of globally that can achieve the objective of no leaks over vast distances. That's the reason why we're asking our federal government, the CSIRO and the Future Energy CRC to help us. This is a massive change. What's all the fuss about? Well, it means we can make pipelines that nobody else can make. The distances, the pricing, the size is just enormous. Our global markets, we put down 11 billion a year. That's who we're talking to today. We expect a significant increase above that in a fairly short period of time. But that's what we're dealing with today. So why? Why is this a valuable company? We've got all the patents on it. We've got the technology proven. We're operational. Our Prodco, our production company in the US, is already underway. We've already got the approvals to go straight to production, and we're production start this year. We've invested 30 million on it so far. We're one of the world's top technologies. Everybody recognises that. We're talking to most of the world's energy companies. And we have the pipe production equipment commissioned in the United States. We have a very large immediate market of approximately $1 billion a year. And then we will grow that in time to an 11 billion a year global. We're highly profitable, and in many cases, we have a very high margin. So his present valuation is about 90 million. Demonstrations in the US should be completed in October, 2,400 miles, which will convert to contracts. They're presently written inquiries, 10,000 miles in early discussions. That's at about $2.2 to $5 billion. Converts 21, 22. Other markets, Australia gas, hydrogen, all the rest of it. It's about 100,000 kilometres that we expect to lock up in a fairly short period of time. We're all looking for the upside. the major inflection point. That's going to come when we've done a few hundred miles. We have a few $100 million in contract and a few billion of projects in discussion around the world. At that point, everybody wants long pipes. At that point, we will probably do ASX listing as a stepping stone to NASDAQ. We've already gone through all of that. You can expect that, not guaranteed, you can expect it probably middle of next year, dependent upon when we hit those targets. We have a top team to do this, yes, and they have done the most amazing things. So yeah, I'm very happy indeed with our team. There's the disclaimer. Nothing that's put in this is anything other than our best understanding at the moment and our best, I guess you could call it, guesstimate of what's going to happen. The future belongs to those who invest in it first. That wasn't from me. That was from one of our Singapore shareholders who sat me down one day and said, "You guys are the future. I need to invest in you now because I want to own part of the future." So thank you for taking a look. The video enables us to skim through these pages and then you can go back and look at them at your leisure. So thank you for looking. I hope at the end of this that you recognise that we are a global company in build and you can choose yourself whether you go for a heavy HDPE pipe or the new lightweight high performance fluid highway. I hope you choose fluid highway too. Thank you.
Thanks, Neil. Next to present today is Vpply, a web application that allows candidates to apply for jobs with a video profile. Founded in 2019 with the vision to disrupt the recruitment industry and move away from the stale and inefficient way of applying for jobs, the business is now looking to showcase this venture to the wholesale investor network. Here to talk further about this venture is CEO Tom Lipczynski.
Thank you for your time today and the opportunity to showcase Vpply. My name is Tom Lipczynski and I am the CEO, and today we are looking to raise $300,000 for 15% of our company. Now, Vpply is a web application that allows candidates to apply for jobs with a video profile. Vpply was founded in 2019 with a vision to disrupt the recruitment industry and move away from the stale and inefficient way for applying for jobs. We all know that looking for new jobs is a slow and inefficient process that often starts with typing blank searches in various job sites to see what's out there. Now, results shows endless pages of listings, and usually job seekers apply for many jobs using one-click apply, not knowing what they really want. This process is very time-consuming and impersonal for job seekers, with the name-based biases coming into play once the job has been applied for. Looking from a potential employer's side, the process is also outdated. There is considerable time cost associated with looking at hundreds of CVs, and it is difficult to gauge the culture fit, usually seen in the interest section in a CV. Vpply looks to improve on the job seeking process by applying for jobs with a more personal approach using video. Vpply looks to address the time to hire cost for employers, as well as allowing the recruiter or hiring manager to meet the job seeker from the get-go. Now, using video also eliminates the name bias. Recording a video allows candidates to make an immediate, personalized impact and, most importantly, stand out to potential employers. Employers, on the other side, can easily screen candidates using our technology and meet their future outstanding employee without as much as an interview. Now, this shortens the recruitment cycle and allows employers to spend more time with the most promising candidates. Vpply presents a simple solution to start the job seeker journey. Now, using the web-based application, the whole search, click, and apply process can be completed in just a matter of minutes. Now, using video in job search market is gaining traction with various job interview platforms launching over the last couple of years. Video My Job focus on employers posting jobs. HireView and My Interview perform the second phase of the job seeker journey, which is the video interview, and could potentially be partners in the future. Now, Goldie, on the other hand, is a video-based job board that Vpply will compete against. However, they are based in the US and only have 20 jobs listed in Australia and 300 globally. The global job search industry is valued at over 20 billion USD, with SEEK controlling the majority of the recruitment services market in Australia. COVID-19 crisis has changed the employment climate globally. As of May 2020, there are now 825,000 job seekers in Australia, which is almost 10% of the population. Saying that, being visible in this crowded market is more imperative to job seekers, and Vpply provides a platform for job seekers to stand out. Based on recent trends, Vpply will target areas of growth, including retail, hospitality, manufacturing, and entertainment. My background is working in recruitment startups, including Adzuna and Indeed. I was the third employee at Adzuna, a Fairfax-backed job site, and I quickly built up the largest book of business in the company. My success ensured that Adzuna in Australia was profitable only after 2 years in operation. And after that, I moved on to Indeed, where I signed and held 2 of the 5 biggest accounts in Australia amongst 120 staff in my 5 years there. I represented Indeed as a brand ambassador, a presenter at events and awards in Australia and also in Asia. My passions lie in adopting smart and efficient technology, and I am truly excited to be part of Vpply. James is the Vpply CMO, who has led various brands and achieved over 20 million in revenue to date, while Paul is in charge of the Vpply development and has been responsible for building ecosystems for a number of different startups. Now, during our short time in existence, we have secured 3 non-executive directors. As you can see, Nat started the pay-per-click job board at Adzuna that I talked about briefly before, and he has previously worked at eBay and Gumtree. He is very passionate about startups and digital businesses. Tanya is based in Perth and has 15 years executive experience in operations, including Chandler McLeod, and now being the MD of Brunel. She's very highly regarded and connected in the mining sector. Jason has been awarded the Recruitment Leader of the Year in 2020 and has over 30,000 LinkedIn connections across various sectors. He's also the chairman of the NPA Worldwide, which includes a global job board, and is the vice chair of the Australian Recruitment Association. Now, our evaluation is based on the product being built and tested in 5 countries with 5,000 bidder users and a scalable business model. We have the personnel to increase the users and job listings rapidly with a strong network and advisory board, along with various integration partnerships close to being finalized. Global trademarks have also been secured. The funds for this raise will be used to bolster our technology, start paid marketing campaigns to attract job seekers and employers to our site, staffing costs, and legal and web hosting costs. The target for 2020 will be to attract 5,000 job seekers and also 5,000 jobs. Over the following years, Vpply will look to secure 250,000 users with the same amount of listings with $10 million in revenue in 2023. Our revenue model will focus on employers sponsoring key jobs, gaining access to our video resume database, or showcasing the company profile for maximum brand exposure. There have been an impressive increase of brands adopting video. I am including 2 case studies here to show how video adoption has helped 2 vastly different businesses in different times with the recruitment process. Coles, during the height of COVID, managed to shrink the recruitment cycle from 20 days to just 2 by using video technology. Hoyts, on the other hand, has decided to eliminate CVs altogether and focus on 60-second videos for young job seekers. This increased the rate of success of hire from 30% to 80%, increasing the quality and reducing the quantity, which is often a hurdle for hiring managers. So I end today's presentation with a quote from Video My Jobs founder David Makioka. Globally, video now accounts to more than 50% of online traffic and is 1,200% more likely to be shared online than text or images. The human preference for video is so strong that YouTube is predicted to overtake Google as the world's favorite search engine. So thank you very much for your time and consideration, and please contact me on the Chris Deal Room link below if you are interested in the investment or have any questions. Thank you.
Thanks, Tom. We now welcome keynote speaker JD, founder of Sales Direct Central, who will be providing us with insights around going from startup to scale up.
Hi there, my name is JD from Sales Director Central. Thank you to the guys at Wholesale Investor for this very brief chat. Sales Director Central, we provide sales acceleration and sales leadership with companies. We care about, our purpose is we care about creating a better future by changing the way the world views sales. So we work with tech companies, business owners and founders between $1 and $20 million that want to scale and grow. So at $1 million, someone can sell it. The founder typically can do it. But what they struggle with is finding salespeople. They've hired and fired salespeople. Deals slip every month. They try and be all things to all people. They're time poor. We work with those organizations in providing some sales leadership to provide the scale and grow. And in fact, we offer a money back guarantee. If we can't double your investment in us in 12 months from a revenue perspective, we give you your money back. We also work with investors, if you like, doing their due diligence on a particular organization. We have a review that we provide to them to make sure that they are sales ready. Which is a variation on the blueprint, which I'm going to talk to you in a moment. So the two main organisations that we work with. So here, what do we see in the marketplace? When we're doing our review with companies, our blueprint. So the first thing we do is come in and look at, from a cradle to grave perspective, what the sales process, the sales pipeline looks like. And what we've done in well over 50 different blueprints for different organisations is we see a common set of challenges and problems in most organisations. And I want to share some of those things with you. The first and the biggest thing that you can do in your business, so if you're a founder of an organisation, if you don't have a sales methodology, so then I absolutely suggest you go and get one. What is a sales methodology? There is a sales process, which is we've met them, maybe had discovery, done a presentation, done a proposal. It's a 5, 7, 12 step approach to where they're at in our cycle. So two things. The first thing to that is stop tracking the sales process, start tracking the buying process. How does your potential prospect make a buying decision? But the sales methodology is a structured approach to data. It's a framework to look at data from a really similar viewpoint. So recently I was asked about sales methodologies and I listed 30 quite quickly, but it could be target account selling, strategy, strategic selling, spin selling, Sandler, Bant, Medic, Strongman, Scotsman. There's a whole variety of different methodologies that we could be using. I really don't care which one it is. We do have a preferred version that we utilize, but have a methodology. If you do get a sales methodology in your organization, what it means is that you're looking consistently at customer data from a variety of different organizations. So you're no longer doing, to my next point, the regular deal reviews. You're no longer looking at an opportunity in terms of what you're doing next. Too many salespeople that I see that aren't performing know the next step, and they know what they're going to sell and how much they're going to sell. They don't know why someone's going to buy, when they're going to buy, and who's going to make a buying decision. So a methodology will enable that part of that process. No regular deal reviews. There's no structured approach to looking at customer data. The more effort we put on understanding where we're at in an opportunity, the better off our tactics and our tasks are going to be kind of rolling forward. Part of our blueprint, we also look at proposals and presentations. And probably to no surprise to everyone watching this, that the proposals and the presentations tend to be all about us, the selling organization, not about the customer. So the proposals might have a paragraph about them, if at all. Did a review recently and the proposal was absolutely all about us, how much we are, what they're going to buy, how we would implement, picture of head office, all the things that ultimately a customer doesn't need. If a customer's trying to get a consensus of change within a corporate, say, what they need is to understand enough about the business problem, how much it's costing them, and if you like, be able to almost work on a business case, not a proposal. So the proposals, the bulk that we see, they're all about us, our product, our price, how we're going to implement, and the presentation's the same. Presentations should be all about the customer, why they have to buy, what their problem is, what issues and challenges and concerns that we have. The next thing we see is what we call educating versus qualifying, or education versus qualification. Most founders, when they're getting into an opportunity early, they want to get to the software super quick. One of the fascinating things about talking to founders, I've been told this about 1,000 times this year, is JD, you don't understand, we have the best product in the market. I continually hear that, and I love the fact that they have the energy and enthusiasm by the fact that they've got the best product in the market. But no one actually wants to buy your product. If we're flipping the laptop too early in a presentation, we're educating the customer on the things that we can do. We're not qualifying or understanding whether they've got a business case or qualifying whether they can get consensus of change or the people that are responsible for allocating budget to this assignment. So from an education qualification perspective, stop educating people, stop talking about your product too early, and start qualifying and understanding why an organisation is going to go and buy. The next point I've kind of made already, 90% of pipelines that I see from salespeople, they know quite well what someone's going to buy and how much. They understand the price. What they don't know is why someone's going to buy. What's the business driver? When we do deal reviews that we talked about a little earlier, one of the things we set up with a deal review is, I'm not interested in what you think the customer thinks and feels. I'm interested in what you know the customer knows. So do you know why they have to buy, and have they elaborated that to you? Do you know when they need to buy it? There's no use offering someone a 10% discount if they buy it this month, because they're going to just take the discount whenever they feel like it. And what it does is it mitigates or minimizes the value that we've uncovered during the process of having the discussion and the discovery. We also certainly don't know who. Most pipelines that we review are very point sensitive. It's the contact person is about the only person really in the organisation that we know. So we look for these things, they become part of our blueprint. We then report on them as part of the end of the process of the blueprint, and we feed that information back, as well as some of the workshops and things that we're going to start to drive as we start to work within an organisation. So one of the things I'd like you to start thinking about, if you're a founder watching this, is stop talking about your product. No one's interested. In fact, we have a customer of ours that was walked out of a very large telco company a couple of times because people wanted to start talking about and telling him his product wasn't any good. So stop talking about your product, start talking about your passion. Remind everyone why you've done what you've done and the gap you saw in the marketplace, because those two components will align completely with why a customer is interested in talking to you. No one wants to buy your product. No one's interested in a product. They do want to solve a business problem, and the problem that you've seen and created a product for, they want to understand how that's going to help their organization, not your feature, function, and productivity. One of the things we talk about is if you talk to a prospect about features and functions, you get to a price discussion. If you talk to a prospect organization about business drivers and business risk, you get to return on investment conversation. I know which one I'd rather have as we go through it. So what is the only thing we measure in sales? This is a slide I throw up often when I'm running sales events, sales kickoffs. Most people think the only thing you measure in sales is revenue or sales, and I understand why they think that. We believe the only thing you measure in sales is time. Stop wasting time. If you spend more time educating people, knowing what they're going to buy and how much, and not enough time understanding whether they're qualified or not, who's going to buy, why they're going to buy it, and when they're going to buy it, you spend more time in front of people educating them, you're less likely to meet your targets. If you spend more time in front of people that have to make buying decisions, that have an absolute business driver and demand, and potentially even have a budget for it or a project already, then you're more likely to make your sales target. So what's the only thing we measure in sales? It's time in front of the right people. One of the things that we talk with organizations about is how do we get to the stage where we're spending more time with their organizations. So as part of this presentation, or giveaway, I wanted to offer two things. One is that I'm going to be online for questions in a moment. But secondly, if you wanted to get 30 minutes of my time and ask me whatever question you like regard to your business, either send me an email, which is jd@salesdirectorcentral.com, or find me on LinkedIn at JD the Catalyst. Happy to spend any time if you reference this session with Wholesale Investor. So thank you for listening. I hope you got some value from it, and I look forward to chatting to you soon. Cheers.
Thanks, JD. Our next presenter today is Eleusian Biosciences Corp, a Toronto-based company focused on the development of therapeutics for multiple pathological psychological diseases based on psilocybin compounds. Here to talk further about this opportunity is Jonathan Gilbert and Masood Dariani.
Hello, my name is Jonathan Gilbert. I'm the CEO of Eleusian Biosciences Corp. I'm coming to you from New York. Our company is based in Toronto. We're a research company focused on psilocybin and all psychedelics. Currently, we have a research project going on at the University of Miami, the Miller School of Medicine. We're testing psilocybin, MDMA, and NAC in its efficacy to treat PTSD and also MTBI, that's mild traumatic brain injury, and those who have suffered a mild traumatic brain injury and also suffer from PTSD, both. It's obviously a pervasive problem right now, not only in Canada and in Australia and in America, but the entire world. My history goes through a few organizations that I think you'd be interested in. I launched in 2014 a cannabis company called Scythian Biosciences. We ultimately went public, cross-listed on NASDAQ, and I exited that company in 2018. I quickly began a psychedelic-focused company called Tassili Life Sciences. Within 8 months, I had sold Tassili to another publicly traded psychedelic company and exited that one successfully as well. The team is made up of myself. Mike Dye is our CFO. Masood Dariani, who's on this call with me right now, and you'll be hearing from in just a few minutes, is the Chief Science Officer. And Mike Petter is a director. what we've done most recently with Eleusian is we've been acquired by Green Star Biosciences, a publicly traded company in Canada on the Canadian Stock Exchange. So now we are a subsidiary of a publicly traded company called Green Star. I have joined the board of directors, and Masood is Green Star's chief science officer. We're very excited, and the ticker symbol, just so your investors know, is GSTR on the Canadian. That's for Green Star. We do have some advisors that have come along with us to Green Star from Eleusian, Dr. Dawn DeCuna, Dr. Shlomo Pinkowski, and someone you may recognize, former NFL athlete Bart Oates. Bart Oates is not only a former NFL athlete, but he's also the president of the NFL Alumni Association. The alumni of the NFL, National Football League here in America, obviously is an organization that's extremely concerned and focused on neurological disorders, pain and suffering, any really ailment that comes from playing such a violent sport like football. So Bart and the members of his group, the NFL alumni, are obviously extraordinarily encouraged by the research that Eleusian and Green Star are doing here to cure and treat these incredibly difficult problems for people that suffer. So we're extraordinarily encouraged, excited, focused on our research. I'm personally affected by any drug that may come to market that could treat any form of neurological disorder. I have 3 sons. One of them in particular suffers from a disorder called Tourette syndrome, who I don't know if many of you are familiar with. But with Tourette is coupled with other things like OCD, anxiety, mild depression. These are the types of disorders and conditions that we're told, and what we hope the psychedelic sector will be efficaciously treating. There are many of our competitors out there that are working on drugs right now to treat depression and anxiety and solve, obviously, a worldwide epidemic. So let me introduce my partner and the Chief Science Officer of Green Star, Masood Dariani, who will take you through the specifics of some of the science that we're working on at the University of Miami and let you know exactly where we think we're going from drug research all the way to commercialization. Masood?
Hello, everybody. I'm Masood Dariani, Chief Scientific Officer of Eleusian, now a subsidiary of Green Star. As Jonathan said, we are focused on treating PTSD alone or PTSD-associated MTBI. These are serious disorders, and you can see on this slide all over the world. Approximately 10% of the people suffer from PTSD sometimes in their lifetime. There is a huge market potential in terms of a global expenditure for mental disorders, and PTSD is a major portion of that. Significant number of veterans throughout the world, as well as significant number of athletes, suffer from MTBI, mild traumatic brain syndrome. And Australia is no exception, the same as United States and rest of the world, represents a huge market opportunity. Psilocybin or MDMA assisted psychotherapy is really taking off throughout the United States, Canada, Europe, and hopefully in Australia. And the way it works when you use these psychedelics, let me just give you an overview of how they work and why they're so effective. Majority of current treatment for PTSD is really covering the symptoms. They're not true treatments. What these psychedelic compounds, whether it's psilocybin or MDMA, is they elevate the mood in the patient and enhance their sense of well-being. And they increase trust and emotional closeness to the psychotherapist that's dealing with him. and enhance their self-awareness. And these actions really open them to start talking to the therapist. And in significant number of cases, it has shown to be very effective. That's why it's picking up significant steam throughout the world. One of the issues with it, obviously, is that these compounds are Schedule I controlled substances, and you have to jump over several regulatory hurdles, such as in the United States, DEA and FDA, to have access for them. And there are movements around the world that are trying to overcome and make these more readily available to patients throughout the world. Besides PTSD and MTBI with PTSD, these psychedelics are also effective in a number of other disorders, such as alcohol and drug abuse. There are clinical trials ongoing that are trying it for this. It may be very helpful for Alzheimer's and Parkinson's, OCD, obsessive compulsive disorder, schizophrenia and bipolar, depression, anxiety disorder. Currently, there is a clinical trial in phase 3, human clinical trials for drug-resistant depression with MDMA, and FDA United States has actually granted it a special protocol where people who cannot actually join these clinical trials can start using them. So it's really, the doors are opening, and our timing to move into this arena is just perfect. What we are doing at Eleusian and Green Star is that we are combining either one of these psychedelics, particularly either psilocybin or MDMA, with another compound that has been shown to be very effective in treating MTBI. That's N-acetylcysteine. And that's an over-the-counter drug. In phase 1 human trials, they have shown it to be very effective for MTBI. And we at the Eleusian and Green Star believe combining NAC, which has neuroprotective properties, with either one of these psychedelic compounds will result in superior efficacy. And that's where we are right now. We are working with a multidisciplinary team of scientists at University of Miami School of Medicine. The team covers the whole span, and what they're doing right now, using established, well-accepted animal models, specifically rodent models, to show safety and efficacy of our combination therapy in PTSD alone and MTBI PTSD associated with MTBI. We are right now in the midst of doing these animal studies, and once those studies are completed and we establish safety and efficacy in these rodent models, our plan is to move into preclinical IND. IND stands for Investigational New Drug, IND enabling studies, so that we can prepare an investigational new drug application, submit it to the FDA. We hope to be able to do that sometimes in 2022. And once the FDA okays our application, we are hoping we will initiate human clinical trials to show efficacy of this combination for the treatment of PTSD or MTBI associated with PTSD. That's pretty much where we are right now. If there are any questions, we'll be happy to answer and entertain them.
Thanks, guys. Next to present today is IOT Automation Global. who are addressing the significant problem of employee safety in large-scale underground mining or tunneling projects. IOT Automation has developed internationally patented technology known as the Vpply smart lighting system, which has dramatically improved underground safety, workflows, and efficiency. Here to discuss this further today is Managing Director Robin Payne.
Hello, my name is Robin Payne. I'm the co-founder and managing director of IOT Automation. Thank you for your time today. I would like to discuss with you our company, our products, and with your assistance, where we can take our business over the next few years. IOT Automation has commercialised an AI-assisted lighting system that dramatically improves workplace safety and operational efficiency within the multi-billion-dollar underground mining sector. IOT Automation has recently secured a worldwide patent for this technology. Our company is cash flow positive and highly profitable. We have a simplified business model which generates revenues from both product sales and the provisions of remote and on-site monitoring services. The company is generating significant industry interest within the system presently installed in several world-class mines. IOT Automation is seeking expansion capital of $4 million to fuel rapid growth and capitalise on our current global growth opportunities. Underground mining is a dangerous work environment where serious incidents and fatalities are a regular occurrence. Underground mining involves the drilling and blasting of a vast network of underground tunnels to access the rich ore zones. As the ore bodies are removed, and as a result of the continual blasting and tunnelling activities, there is an ever-present threat of seismic activity, rock bursts and cave-ins. However, during the day-to-day running of the shift, there is no effective real-time mechanism to clearly demarcate to miners precisely where it is safe or unsafe to work, where and when blasting is occurring, and where they should or should not be at any point in time. Seismic and ground movement events have the potential to injure miners and to block their escape to the surface. Cave-ins also have the potential to damage infrastructure such as the mines, communication radio systems and stench gas systems. Ultimately, this can leave the workers trapped deep underground without any understanding of what the problem is or which way is the safest way out of the mine. Mine operations in many underground mines are undertaken in highly challenging conditions, which can be several kilometres underground. Working conditions are generally dark, they're wet, they're hot, and they're humid. There are also the persistent problems associated where there's airflow, dust, and build-up of toxic gas issues. On top of this, workers need to be constantly on the lookout for heavy mobile machines which utilise the same tunnels as the workers, and consequently there is a real and ever-present risk that the workers could be hit or killed by these moving machines. In recognition of these dangers, underground mines and their mine managers deploy a range of safety systems and processes. Some of the more common safety systems are shown on this slide. Each have their own positives and negatives, and typically operate independently of each other, meaning that no single solution provides effective mitigation of these critical risks. Unfortunately, despite implementation of these safety systems, many thousands of serious incidents and fatalities continue to occur, resulting in billions of dollars in associated injury costs, lost equipment, and then thousands of hours of lost productivity. There has to be, and there needs to be, a better way. Our patented software-controlled Vpply smart lighting system provides underground mining operations with the ability to indicate in real time where the safe and unsafe areas of the mine are, to trigger critical safety emergency and evacuation events, as well as to provide visual indication to the underground workers as to the fastest and the safest direction of evacuation. Our Vpply software platform centrally monitors and manages the performance of the entire lighting network. The technology integrates with a wide range of environmental monitoring databases, real-time location systems, and sensor networks, providing mine managers with the tools they need to be able to make up-to-date, real-time situational decisions around the safety of their workforce and mining fleet. Mine operators located at the surface control rooms can quickly and easily utilise the smart lighting system to communicate critical safety information to the underground workers, informing them of what actions they should take on everything from a critical emergency event right through to a normal day-to-day blasting event. At a high level, the system is comprised of three main components: our Firefly LED lighting module, our Firefly control panel, and our Firefly control software, which also includes a web application for remote monitoring. The Firefly smart lighting system enables safety zones to be deployed in real time, whether that be to a small isolated area of tunnel, level wide, or, where applicable, across the entire mining operation. The intuitive Firefly smart lighting system enables safer underground evacuations and emergency responses, as well as providing a cost-effective solution which improves visibility, workflow, and safety. IOT Automation has recently secured an international patent which provides protection across multiple aspects of our invention. Areas protected are of substantial commercial value, particularly within the underground mining sector, as they bring together an intelligent lighting and visual communication system, combined with remote and autonomous monitoring of environmental and other sensors. IOT Automation has essentially created and patented a platform which brings together a wide range of modern technologies with the potential for vast mine-wide safety and productivity improvements. We also recognise that the patented technology has significant potential for future expansion. Just recently, Rio Tinto has estimated that within 10 years, around 40% of all global ore will be sourced from underground mining operations. As such, the lucrative expansion of the underground mining sector is viewed as our primary target market, where even a small-scale block cave mine would generate revenues for our project and products in excess of $2 million, plus ongoing monitoring and service contracts. Our Firefly smart lighting system has significant scope to increase its capabilities through further R&D initiatives, which in turn will enable us to tap into other sectors and industries, including underground coal, major road and rail tunnelling projects, petrochemical, on and offshore oil and gas, as well as other light commercial applications, such as hotels and hospitals. The Firefly smart lighting system is now fully commercialised and is currently deployed in some of the world's most modern and underground mining projects. One such example, as shown on the slide, is the Freeport-McMoran Grasberg copper gold mine in Indonesia, which was constructed at a cost of $6.5 billion. We have also now been attracting substantial attention from other global miners, distributors, and potential strategic alliance partners. The IOT Automation team brings together decades of industry experience and technical expertise. It is also important to note that the intellectual property comprising the end-to-end Firefly smart lighting system has all been developed in-house. For this Series A round of capital, our company is seeking to raise an investment of $4 million in exchange for a 20% equity holding in IOT Automation. This represents a company valuation of $20 million. 100% of those funds raised will be used to fuel the rapid growth of our business. At a high level, we want to engage additional senior management personnel, develop a global direct sales team, further develop the software and hardware capabilities of the system, and expand the scope of the patent protection to further strengthen our market protection, bring elements of our hardware production in-house, and facilitate a larger, more mass-scale production manufacturing capability. IOT Automation anticipates substantial value growth over the next coming 12 to 18 months. The direct sales team will quickly enhance our market penetration into the underground global mining markets. This, coupled with the completion of our planned R&D initiatives, will enable us to expand our technology offerings into underground coal mines and tunnelling projects across the globe. And the future product versions will provide us with significantly increased addressable market and high valuations. IOT Automation also plans to produce various components in-house, leading to substantial cost efficiencies and improved gross margins. Over the course of the next 36 months, we are forecasting to deploy our Firefly smart lighting system into a further 10 to 15 block cave mines, which would yield revenues of approximately $40 to $55 million. IOT Automation's patented system substantially improves underground mine safety and operational efficiency, which has the potential to save lives and billions of dollars. The Firefly technology provides a platform for a wide range of complementary functionalities, which not only provides an enviable market position, but also makes IOT Automation a prime target for strategic acquirers. We believe IOT Automation is well placed to capitalise on its market-leading position and has substantial potential to yield strong value growth over the next coming years. Thank you for your time today. If you would like to make contact with us, please look and utilise the QR scan code at the bottom of the screen. Look forward to talking to you. Thank you.
Thanks, Robin. Our next presenter today is neuroCare Group, who are innovating mental health and performance by personalizing therapy following a detailed assessment. With the current standard of practice being a one-size-fits-all approach with the use of drugs, the side effects often are unacceptable. Here to discuss this opportunity further is Thomas Merkesheimer.
Good day. My name is Tom Merkesheimer. I'm the founder of a company called neuroCare. We personalize mental health and performance. Our vision is to innovate mental health, and the personalized care we provide expresses itself in best-in-class clinical outcomes, but also best-in-class commercial outcomes. There is a real global crisis in mental health. The numbers are just staggering. And if you add sleep, stress, burnout, and mental performance, you're really facing hundreds of millions of people seeking proper help. The cost side of it is equally staggering. If you look at it in 2010, we spent about $2.5 trillion in the OECD countries for mental health issues. And by 2030, this is projected to be 16 trillion. That is really staggering. The real issue is that there's no satisfying solutions. A lot of the approaches are based on medication. Medications have side effects. Medications have a lot of non-responders, and medications don't work causally, meaning they don't really address the underlying issue. Psychotherapy or cognitive behavioral therapy does do that, does have the right approach, does work with what's called neuroplasticity, our brain's ability to learn, but they simply have the issue that they usually do not get paid enough sessions. So the outcome is often difficult to maintain. It's a bit akin you only trying for 5 times to learn to ride a bike or hit a tennis ball or hit a golf ball, and the outcome always will be doubtful. So what does neuroCare do different? In simple terms, we look much more detailed in what the underlying issues are. We look at more dimensions. We look at the brain's function. We do the normal psychodiagnostics. We look at your physical brain biomarkers. And most importantly, we look at your sleep. And from that, we personalize a therapy approach that also includes modern technology that simply amplifies and boosts your learning ability. This is why we achieve best outcomes. The underlying approach from a psychological perspective is called enhancing your self-regulation, instead of thinking or fooling us into thinking that we can eliminate a depression or an ADHD just like a broken limb. That's not the case. So self-regulation means that your outcomes are sustainable, and personalizing means that your outcomes are best. This is also evidenced when you look at our outcomes compared to the other approaches, and especially when you look at the therapeutic approach to the right. We have the most objective, the most causal, and the most focal approach. Please go onto our website and inform you more. I also want to share with you that neuroCare is the digital therapeutics company, because all the technologies we have to boost your ability to learn and to heal are, of course, able to be delivered remotely, both the assessment and the therapy. And we really include artificial intelligence and deep learning algorithms. I don't think I have to stress that these days, also partly driven by the COVID crisis, the regulatory hurdles and the market reception is much growing or changing. This is why in the long term, neuroCare will be akin to software as a service business, and why in the long term we have those two divisions. The clinics are our credibility. Here we cure 1,500 patients per year. And the solutions is basically offering all our technology services, training to third parties to do the same. Let's quickly look at the market. If you only think of the OECD countries and the countries we are already active in, the 15% mentioned here, and a very small market penetrations in the first 5 years, we already have a potential of 3.5 billion to be addressed. Most of what we do, the technology is used, is reimbursed in the big global markets. And also what we do is actually, because it's a one-term average, 3 months, 30 session treatment, it's actually a lot cheaper than all the current approaches. We have surely assembled the world's best team. Please go onto our website. We have the technology leaders and pioneers, the management and the scientific leaders and pioneers in our team. You can see the 2 key people in management listed here. I myself am not only an electrical engineer and understand the technology, but I have spent 13 years in healthcare as a very senior executive, building vertically integrated business. And last but not least, probably most importantly for the subject matter at hand, I know the perspective as a patient as well. So what is neuroCare looking for? We're seeking growth funding only. You see to the left, the blue curve is the sales, the green curve is the EBITDA. We have now achieved EBITDA positivity in all clinics, and we have also break even in the solutions division on a very small base, and we foresee the group breaking even in 21. We have a big pipeline of identified projects for both clinics and solutions. So really the 5 million we are looking to raise are all for identified projects. We have a good strategic partner to explore the market potential, the huge market potential in Japan, and we will accelerate our digital therapeutics approach. Please come to us. Please join us. Please go onto our CRISP landing page, use the QR code and join us in making the world a better place. This is a true impact investment. Thank you.
Thanks, Thomas. We now welcome keynote speaker Katherine Heathcote from Austrade, who will be providing us with insights around scaling up international markets.
Hello there. This January, if you're planning to take your business overseas for the first time or expanding to a new market, you probably wouldn't have considered a global pandemic as part of your future planning. However, that's the new reality that we find ourselves in. I'm Katie Heathcote. I work at Austrade as a global engagement manager, and I help Australian companies expand into international markets as well as international companies set up in Australia. Over the last 6 or so months, I've made some observations around what's happening in the local ecosystem with COVID-19 as well as the international sphere. And today I'm going to share some of my thoughts and advice from those observations with you. First and foremost, I've worked in the industry for over 10 years, advising companies on scaling international. And always they come to me and say, it always took longer than I'd anticipated. This rule of thumb hasn't changed, but it'll actually take even longer now, likely in COVID-19 times. I believe that it's even more important now to reassure your existing customers or new customers and investors if you're looking to take on the journey, and if it does take that extra time, to bring them with you on the journey. One of my clients recently told me that what usually took them a week of travel in the US to onboard new clients or partners now takes 3 weeks using Zoom. And it presents challenges and difficulties with getting people across a new system, particularly through a virtual platform. But hopefully this is only a temporary reality, and I think we should adapt fast and adjust to what is required, but also sprinkle a little bit of patience in there as well. Which leads me to my second point. Does your product or service that you've been offering all this time actually fit into the new reality that we find ourselves in? Customer demand and customer appetite has definitely shifted. Now, I'm not making the argument that you should go and sell hand sanitizer, but you need to consider and evaluate your business plan is it foolproof enough to actually fit into current times? The companies that I've seen succeed even during this time are the ones that have adapted their business fast to the current needs, which, for example, we're moving towards a more cashless society, bank branches are closing down, people are demanding more food and beverages being home delivered. There's a whole different array of changes that are happening. And how does your business fit into that? So, which brings me to sort of the crux of this chat today, is doing business in a global market even possible during COVID-19? Yes, but it will be challenging, even more so than before, particularly if you're going in cold. If you're looking to acquire new partners and customers during this time, it's going to be tricky unless you had an existing relationship. Particularly with dealing with Asian markets, where I find trust and building relationships is ever more so important in securing the deal. But that being said, I have noticed that business executives are more available because they're finding themselves less running through international airports or on planes. So there may be an opportunity window there to take advantage of in terms of availability of senior management or the decision makers that you need to get your business in the door. My advice here is to try and find a mutual contact, someone that is well connected in the partner or customer that you're trying to approach. With that being said, it's helpful to go in with a warm introduction than a cold one. And if your contact is mutually respected by both parties, it will go a long way. The other alternative is to consider hiring someone local on the ground in the market that you choose to go to. This helps in terms of understanding language, culture, and also having a network that will ultimately speed up doing business in that market. So just some things to consider. I often get asked during this time about raising capital, venture capital, investment. And I've had mixed responses. But what I've found is that investors, both locally and globally, are consolidating. And I find a lot of industries themselves are consolidating. And investment is going to be harder if you're going in cold, particularly with early stage and Series A companies. They may find this time actually more challenging if they're trying to raise capital. But with that being said, don't be disheartened. Keep reaching out and seeing what else is out there. What I found where there's been success is if the discussion started pre-COVID times and a relationship was built, that would mean the investor was better positioned to lend you the capital or invest in you. So I found the companies that have raised X amount of millions have been because they had those discussions prior to this pandemic. So one obvious one, which is my fourth point today, have you actually looked at what's happening globally in terms of the political landscape, in terms of the economic downturn we find ourselves in, and also changing immigration conditions? Is a visa that you once thought was applicable to a certain market, is that going to still work? If you're considering international travel in this time or moving overseas, then there's a few things you might want to consider. Although nearly every country I have come across has some sort of quarantine mechanism in place and restrictions on how many travelers they're accepting into any given country as well. So I've also seen some countries restrict in terms of applications for visas and permanent residency applications. So just good to be across that, and that doesn't apply to every country, but it's just worth keeping across if you are looking to actually relocate or find yourself you needing to travel to a certain location. There are a lot of unknowns, and it's really hard to plan ahead. And we don't know what the world economy is going to look like in the next 12 to 18 months. But all these different factors are important considerations for your business, and you need to factor them in. It's also worth, on a positive side, government grants are now available to startups and scale-up companies and small businesses to help them along during this time. Now, not just JobSeeker and JobKeeper, but Austrade itself has boosted its export market development grant by $49 million this year, which is available to exporters looking to help them along in terms of their export or marketable activity. And also for payout of any claims that are made for the financial year of 2019 can be put through. Also, I noticed that other government departments are offering a number of packages. State governments, Department of Industry and Science and Energy just announced a $12 million package available to any company in the seed funding stage to help them bring ideas to market to solve problems during this time. So it's definitely worth checking out what's available to you and your business, particularly as there's a lot of support going on out there and funding opportunities, so you're not alone. I can also send a list through at the end of this. So that pretty much sums up my advice to you. But I strongly believe COVID will bring out a sense and a wave of entrepreneurship that we've never seen before. So it's more important than ever to proactively reach out to your contacts and clients and investors and keep them warm. And it's particularly, you need to keep doing that and build the momentum, because if being in isolation, we often, let the ball drop because we're not in contact with these people face to face. So trying to keep up a level of contact is really important, as we will get through this period and we'll be going back to coffee meetings and things like that eventually. So it's good to keep things in check. In the meantime, that sums up my thoughts and observations from this COVID time. I hope you're all safe and well, and any questions, feel free to reach out. Cheers.
Thanks, Katherine. Our next presenter is L1 UK Property Investments. L1 is operating with the outlook of UK residential property, excluding London, offers a compelling risk versus reward opportunity. The combination of high rental yields, low borrowing costs, and attractive long-term supply-demand dynamics makes for an attractive investment case. To learn more about this advantage of the opportunity, Chief Investment Officer Keegan will discuss further.
Hi, my name is Keegan and I'm the Chief Investment Officer for L1 UK Property Fund. A bit of background around L1. We were founded originally in 2007 by Mark Landau and Raphael Lamb. Today, we have about $3 billion in assets under management, and that's well supported by superannuation funds, family offices, as well as retail investors. As you can see on the page, over the past 10 years, we've launched a number of funds across equities, structured debt investments, and more recently, property. Importantly, over the long run, all funds have outperformed their investment objectives and delivered a strong track record of performance over the long run. Today, the focus is on the L1 UK Residential Property Fund, which we find particularly attractive for two reasons. One, the UK residential property, the rental yields are very high, which has allowed existing funds to deliver dividend yields in excess of 7% per annum to investors. Secondly, the fund has the ability to buy or invest in undermanaged assets, which allows us to reposition the buildings as more premium buildings, which essentially enhances the total return profile to investors. Over the page, the fund essentially invests in blocks of apartments in Tier 1 cities outside of London, such as Birmingham, Manchester, Leeds, and Liverpool. What's particularly important for any asset class that we invest in is valuation, and for housing, that's defined as house price relative to people's incomes. In the Tier 1 cities outside of London, house prices typically trade at 3 to 4 times household income, which is substantially more affordable than London, which trades at 8 times, and also substantially cheaper than Sydney and Melbourne, which trade at somewhere from 9 to 11 times respectively. Over the page, what this chart shows is how UK house prices have performed over the past 15 years since the financial crisis. UK house prices, as you can see, were relatively depressed all the way up to 2015 as a result of the sovereign debt crisis, and only in recent years have started to recover to the same levels as they were pre-GFC. What this has meant is, as rental prices have actually grown more strongly in line with people's incomes, rental yields in the Tier 1 cities outside of London are now very high, ranging from 7 to 8%. That becomes particularly interesting when interest rates are effectively near zero and you can actually borrow at a 2% cost of borrowing. That allows the UK residential property market to deliver what's called a positive gearing or a strong dividend yield, where your yield is actually higher than your cost of borrowing. Whereas in most circumstances, most developed countries around the world are more commonly known for having to have the situation of negative gearing. I think over the page, just very briefly, how the UK housing market has performed throughout the current pandemic. Top left-hand corner, you see house prices have remained relatively stable over the past 6 months and starting to return to growth as the UK eases out of the current lockdown. With the UK government earlier this month announcing the removal of UK stamp duty for house prices below £500,000, we expect that to act as a tailwind for house prices in the Tier 1 cities outside of London. On the far right, you can see the long run rental prices for the UK over the past 60 or 70 years. And what it shows is that the UK rental prices are inherently very stable, largely driven by a shortage of housing versus demand, and really just grows very steadily in line with people's incomes or inflation over the long run. That's particularly important for investors as that really underpins a very stable dividend yield, which ultimately comes from the rental income. What we look to basically talk a bit now in this section is to run you through examples of some of the investments that we have made recently in the funds and how we look to add value to generate excess returns for investors. When we make investments, there's really 2 or 3 criteria. We're looking for blocks of apartments which are tenanted and income generating day one, so no construction, no development risk, and really in strong city centre locations in the Tier 1 or larger cities outside of London. Here is a recent example of a block of flats we purchased in Liverpool city centre. Our due diligence suggested that given the strength of the location, the building had a significant opportunity to attract a more premium tenant. So post our purchase, we simply did a small light touch refurbishment and enhanced the building with a bit more premium furniture, which allowed the building to attract rents somewhere from 20 to 25% higher than the previous tenant. And also some of the flats were being able to use to be let out on a weekly or nightly basis as serviced accommodation, which really did turbocharge the rental income and also enhance, therefore, the dividend yield back to investors. The next page shows the typical example which we typically focus for the fund. Here is a block of flats right in the middle of Sheffield city centre that you can see on the map. Strong location right between the 2 universities in Sheffield. It was a building that had been starved of capital investment, hadn't been refurbished for the past 20 or 25 years, and that allowed us to buy the building at a relatively modest price of just $5 million for the 200 rooms or £25,000 per room. We did a very modest refurbishment, as you can sort of see in the before and after photos. And that allowed us to enhance the occupancy of the building and also drive the rents upwards from the present £75 to about £100 per week. Once the building is fully refurbished and fully tenanted at £105 per week, that should generate around a 20% rental yield on the investment. It's worth also mentioning that the fund also selectively invests 10 to 20% of its equity in student property. Because it's a relatively small allocation of the fund, we're able to be very selective and select what we think are some of the best opportunities in the market each year. As an example, the most recent investment that we made in student property was in Stockton-on-Tees for a Durham University campus. We purchased 225 beds spread across 12 buildings for about £1.7 million. Given the strong location of the building, we had a strong belief that the university had a definite use for these rooms. So shortly post us purchasing the buildings, we signed a 4-year rental guarantee with the university at about £1.3 million per annum. Given our entry price at £1.7 million, that equates to a purchase price of around £7,000 per apartment, or a rental yield of about 75%. These metrics help enhance the dividend yield for investors, and also now with the lease in place, the building is likely to achieve substantial capital appreciation. I think finally on the last slide, just wanting to touch throughout the life of an investment, what the return profile for an investor would look like on a property by property basis. So here's a property that we purchased around 3 years ago, and under each year of our ownership, the building generated net rental income of around £300,000 per annum that you can see in the bottom left-hand corner. That translates or winds back to around a 7% dividend yield, which is being paid back to investors on an annual basis. Under our ownership, we were able to improve the income profile of the building by improving the lets and also doing a bit of refurbishment of the ground floor commercial units. With a 30% increase in the net rental income, that led to around an £800,000 improvement in the purchase price or capital gain on a sale. Once you subtract all the costs, including the cost of debt and interest expense, that winds back to around a 1.6 times money multiple or a 16% IRR. So in a typical investment, what we're looking to achieve is to have a strong, stable dividend yield of around 6 or 7%, and the asset management strategy to deliver strong capital growth so that the total return profile is somewhere in the mid-teens for the underlying investor. Thank you again for your time for listening to the presentation. I hope you found it insightful, and please reach out if you have any further questions.
Thanks, Key. Presenting now is SaaS platform Eratos, which is shaping the way data scientists interact with and collaborate around data. The solution provides context and meaning to data for richer and more powerful insights. Here to talk further about this in detail is CEO Steve Taitoko.
Great, thanks for having us here today. My name's Steve Taitoko and I'm the CEO of Eratos. So Eratos is a data platform used by data scientists to help them to speed up the ability to analyse data from the physical world. It also helps them to collaborate to make decisions and analyse around some of our biggest problems we face as a society and as humanity. But data science inherently have barriers to the way in which they interact with and analyse data. Up to 80% of their time can be spent just finding and cleaning up data to be able to analyse. And then the environment they operate within, the data sitting in silos, or the velocity of data coming at them is extreme. So there's just a lot of barriers and impediments in the way they can efficiently manage data. So the solution that we've worked on is relying on the FAIR principles. So we want to make data findable, accessible, interoperable, and reusable, so that data scientists are actually spending more time on their domain expertise as opposed to the routine and mundane tasks of finding and cleaning up data. So those data scientists, typically for us, the target markets are sitting within industries such as construction, agriculture, supply chain, logistics, industries where there's very low digitisation. So they're also the industries that will benefit the most from the transformation from a low digitisation to a high digitisation workflow models. So therefore, the value that they'll unlock through going through that transformation will provide high ROIs and the ability to use platforms such as Eratos to help them in that transformation and transition to digitised workflows. The product itself, effectively the secret sauce around Eratos is the core protocols that have been designed and used, the way in which the data is ingested. So we looked at the problem from the context of where's data going to be generated, where's it going to be stored, and we're moving from that centralised on-premise data storage and generation to edge generation through IT devices, where corporates are moving to, our enterprise customers are moving to multi-cloud tenancies. So the data is shifting rapidly from just a centralised mode to a distributed mode. So at its core, Eratos is a distributed data management platform. And through that, it's got some fundamental advantages over the way in which data is managed at the moment. It's got an ability to track data. It's got an ability to, with its advanced search algorithms, to be able to find that data. The competitors space that we're working in, the natural competitors for Eratos are typically sitting in an adjacent structured database market where they're working with quite uniform data sets being generated from things such as social media, retail sales data, financial type data sets, whereas ours are data generated through IoT networks, so sensors out in the field, satellites, drones, and such forth. So we're in an uncontested market space, and it's a very new type of technology, and it's a very new type of application and analytics around our ability to start to make decisions around the world we live in through the ingestion and consummation of data from the physical world. One of the recent developments within Eratos is a partnership with the CSIRO. We're transitioning some technology that's been 6 years in development within CSIRO. It's an adjacent piece of technology to the core Eratos platform, so we're working through a process of transitioning that technology into Eratos, and aside to that is also joint sales and marketing promotion through CSIRO's network of research institutions, industry partners, and government agencies. So it's a really exciting development for us, and we see it as a key part of our go-to-market and commercialisation strategy. At the team, we've got a diverse team. We've all worked within startups in the past. We've had our successful exits. The development team have developed over 50 different types of platforms, applications, sophisticated network systems. So we've been here before, and the challenge we've taken on is a large one, but we're mostly through the computational and heavy architecture design work, and very excited about what we're seeing in terms of our early stage pilot applications and programs are running. We've just started this funding round, so we're looking for $1.5 million of new equity. We're augmenting that with an application for an accelerating commercialisation grant in the order of another $1 million. So that'll get us through the next 18 months. And really for us, we're working in stealth mode. So you won't see a lot written about us. You won't see a lot on our website. And it's purpose built because we're building an enterprise grade platform, and we need time to work sort of depth with a small number of large customers to start building out the functionality and the robustness of the platform to be able to scale when we get to that point. So the next 18 months is all about inwardly focused with really engaged customer base before we throw the covers off towards the end of next year and start to scale the platform in the business. So key milestones over that period, we're really focused right now on integrating the Synapse platform into Eratos. We see a huge amount of opportunity through the customers that are already engaged with the Synapse platform, as well as the opportunities that Eratos has. The integration work's going really well, and we're really excited about the possibilities of putting those two platforms together. That will then lead through to effectively version 1.0 of the platform, which will be towards the end of this year. which allow us to start to go out broader than the pilot programs we're currently on at the moment. So we're looking at about 50 new customers over the next 12 to 18 months, and they'll all be large customers with complex data problems, and most specifically within those target industries of things like agriculture, construction, natural resource management, utilities. Post that, towards the back end of next year, as I said, we'll start to throw the covers off Eratos and do the full platform launch, and really start to execute on our go-to-market strategy. And at that point, we'll be looking to enter our Series A round, which is all about scaling the platform. And that's a globally scalable platform at that point. So some of the investment highlights, the core platform's built. It's out there. We've got a number of pilot programs underway at the moment with large organisations. The CSIRO partnership's in place. It's strong. Where both parties are excited about the possibilities of the integrated platform. We are in a blue ocean market space. It is uncontested. There's no incumbent. We believe that we've got every chance of being the incumbent. And with that, we're building up the network effect for the business to build that moat that has the best data sets, the most data sets, and the most engaged users, which will be attractive for any other new user to the platform. So thanks for listening, and come and visit us at our deal room on Crisp. Look forward to hoping you meeting you one day. Thank you.
Thanks, Steve. Our final presentation today is Banxa, an internationally compliant payment service provider servicing crypto exchanges, wallets, and other cryptocurrency businesses. Banxa offers global and local payment methods like credit cards and retail store networks. Here to talk further about this is founder Dominic Carozza.
Hi, my name is Dominic Carozza, founder and chairman of Banxa. Before I move into the prezo, I'd just like to give everyone just a bit of an overview with regards to what I'm going to be talking about. Bitcoin and crypto these days is really moving away from the techie nerds to being a new asset class. We're seeing an increasing number of family offices, institutions, high net worth investors moving into the space. As of today, about 50 million cryptocurrencies exist globally, and that continues to rise. And there's a little graph that I've posted there as well. And really, this really sets the scene for Banxa. Right now, about 1% of the world's population has access to crypto. And really, in order to get involved in this ecosystem, you need to start with crypto. But as we know, most people start with fiat currency. When I mean fiat currency, I mean the Australian dollar, the US dollar, the euro, etc. And that is really the major problem that Banxa is trying to solve. And that is we are building the payment infrastructure that will connect the current fiat world with this new crypto, this new digital asset world. And so we are, from a technical perspective, we're building the fiat on and off ramps. And that's really the focus of the business. Here's actually a quote by Paul Tudor Jones, who's really considered the father of the modern day hedge fund. I'm not going to go through and read all of that. Suffice to say that he, highly conservative investor, now has between 1% to 2% of his portfolio in Bitcoin. And you can Google him and find out more about that. In terms of Banxa, we are building a global PSP payment service provider that connects the old fiat world with the new digital world. And our mission is to onboard the masses, to make it simple in terms of allowing consumers to get access to crypto. And the way that we're doing that is because crypto these days is regulated, unlike a number of years ago. In order to operate in the space, you need to do we do full AML KYC on customers, basically like a bank. And so in order to do that, we are building a fully regulated infrastructure that allows the fiat on and off ramps. The company has been running for 6 years, so we're really considered, veterans in the space. We are now in the process, the final stages of listing onto the Toronto Stock Exchange. There's about 30 plus people in the company, and we basically do full AML KYC, and I've mentioned that just before. And really, the solution that we provide is, and I'll try not to get too technical, but we basically provide a single API, which basically means a single connection that we plug into existing crypto to crypto exchanges. And some of our customers include Binance, OKX, KuCoin, and you may have heard some of these brands. So we basically deal with the payments, the regulatory layer, the full AML KYC, and basically we just make it really simple for our customers to onboard the other 99% of customers or people out there that are yet to experience crypto. To date, we offer over 30 different payment methods. Not only do we offer credit card, but from an Australian perspective, Poly and Vpply, SEPA for the European network, and instant transfers in the UK. And our payment infrastructure is growing on a day-to-day basis. We also have an exclusive deal with Australia Post, whereby you can walk into any Aussie Post location, hand over some cash or a debit card, and you can basically get crypto sitting in your wallet in less than 60 seconds. And that deal took many, many years to complete. Some of our existing customers include Binance and KuCoin and OKX, and I've mentioned those before. And we have a very strong pipeline of new customers that we're in the process of onboarding. The way that we make money is that we charge a combination of commission and spread. And so in effect, think of it a bit like an FX broker. We're building this infrastructure, building the toll roads, and anytime someone uses our toll road, we basically charge a fee. One of the key metrics that we utilize in the business is TTV, total transaction volume. Our business is up 400% in the last 12 months. And last quarter, Q4, which is the June quarter, we did just over $46 million worth of transactions. And we're obviously very pleased and very happy with that performance. We've got a great team who's done a fantastic job, led by our CEO, Holger Arians. He's a German national, now living in Australia. And as I like to say, or as we all like to say, he runs the business with German precision, which is exactly what we need. And then we have Josh and Ian with significant experience across EY and Goldman Sachs as well. We are listing on the TSXV for a number of reasons. The Toronto Stock Exchange is a well-known exchange in North America. And there's a number of reasons. One is to provide greater transparency to our customers. And the fact that we will be audited just provides a high degree of corporate governance for a company such as ourselves, as well as the ability to dual list in the US through the OTC and Europe's Frankfurt exchange as well, which would just, in effect, help us increase the liquidity. Right now, we are in the process of raising 2 million Canadian, which is about 2 million Australian dollars, through a book build process. And if you contact me, I'll be able to send you the link, and you'll be able to, in fact, even use Australian dollars to participate in that raise. The next slide is just really giving an overview of the capital structure. We will have a market cap of 37 million on completion, and the shares will be $1 Canadian each. The top 10 shareholders, this is just a bit of a snapshot. Board and management own about 30% of the company. The next three investors are funds, institutional funds. Both Allium and Thorney are Australian-based investors, and then NGC is a very well-known investor in the blockchain space in Asia. And then we have the OK Group, or OKX, and KuCoin also there as strategic investors. In terms of the process and timeline, we've been working on this for almost a year. We are now in the final stages of our IPO capital raising, and we are on track to list at the end of August. In terms of the comparables, I think this is an important slide for many investors. Right now, we will be listing with a market cap of $37 million. There are a number of comparables such as NetSense and Galaxy and Voyager, and they've all got valuations well in excess of Banxa. And just to give you some metrics, if you combine the revenue of NetSense and Voyager, and if you combine their revenues, Banxa more than doubles their revenue based on our last quarter, and they collectively have a market cap of close to $200 million. So you can see on a pure comparables basis that there's, in my view, significant upside for new investors. So really, in terms of the process, it's through a process called subscription receipts. It's for accredited investors only. If you contact me through the platform, I'll be able to send you the link and giving you, some further details in regards to how to participate in the Banxa business. So thank you very much for your time, and looking forward to having you on board. Thank you.
Thanks, Dominic. To finalize our showcase, we will now have a panel session on the rise, discussing mega trends worldwide, driven by active entrepreneurs in the spaces discussed. Enjoy.
Welcome, everybody. Thank you so much for joining us on this panel today. I'm Andrea Gardner, the founder and CEO of Gelix Ventures. Gelix invests early in technology startups, and we back daring founders to change the world. On our panel today, we've got Niv Dagan, and excuse me if I'm not pronouncing anyone's names correctly. He's the founder and executive director at Peak Asset Management. And he's here to be talking about investment opportunities in mushrooms and medical cannabis. We've also joined by Jonathan Ruddick, who's the Chief Commercial Officer at Planet Arc Power. And he's on the panel today to bring in his expertise on renewable energy. We've also got with us Henrik Anderson. Good idea if you guys wave your hand, because for some reason we haven't got the names coming up on the screen. He's the CFA and Chief Investment Officer at Apollo Capital, and he's going to be telling us about the global trends in cryptocurrencies and DeFi, which is decentralized finance. That's not something that I know much about, so I'd love to learn more. And Vpply, is it Vpply? Yeah, Vpply. Yes, Vpply Mozkov. I'm so sorry. Can you pronounce it for me, please?
Yeah, Vitaly Mozkov.
Oh, thank you. Okay, Vitaly Mozkov. I should have asked you before the panel, sorry. And Vitaly is the head of the Innovation Hub at Kaspersky, and he's going to talk to us about global investment trends in cybersecurity. So we might just kick off today with dive straight into the questions. So the first one I'm going to address to you, Vitaly. Can you tell us a little bit how your company innovates? What does innovation mean to Kaspersky and the Kaspersky Innovation Hub?
Yeah, sure. Well, the innovation for both the company and the Kaspersky Innovation Hub means mainly three things. The first one, we open eyes. We look at the other technological innovators around us, because throughout the more than 22 years of experience in the cybersecurity, we saw that there are many other companies around us working on the very same mission, cyber defending the world. And instead of competing, we want partner. And this is the second thing. So it's the innovation for us means like an endless partnership opportunities with those innovators, with not only startups, but also with the small groups of people doing some crazy stuff in the cyber defense and cybersecurity. And the last but not least, I think the most important for us, not even kind of monetization, but the even more important, the timing. So the innovation for us means that we have breakthrough solutions rolled out to the market on a timely fashion, faster than we can develop themselves. So all other successes, the benefits, the revenues, the recognition, and all this stuff kind of are results of those three things. So that's what innovation means to Kaspersky and the Kaspersky innovation habits inside it.
Thank you so much. So what I thought I'd do is just talk about, just to get to have a feel for each panelist specialist area. So next we'll go on to you, John. Can you tell us about what you think are the future requirements for the renewable energy infrastructure?
Sure, that's it's actually a very broad question, but
yeah.
I just preface it by saying what we're trying to achieve, and this probably goes to most grids in the world now. We're trying to move from a centralised electricity grid to one that is powered by distributed energy at the point of consumption. So by that I mean rooftop solar. Electricity grids were designed basically to send power one way, and by putting solar systems on rooftops, what we're actually doing is sending power back the other way. And so what the future requirements are, and actually what our Alexis technology enables, is the ability to be able to send that power back the other way without causing instability in the network, and therefore create a distributed renewable grid of the future.
Awesome, thank you so much. Jumping around from subjects again, so on to you this time, Henrik. This is totally different subject. So what are the latest global trends in cryptocurrencies and decentralized finance?
Sure. So one of the huge trends now in the crypto markets are decentralized finance, also called DeFi. That is about building a new financial infrastructures on top of open blockchains, meaning that you can build a new infrastructure that is open to anyone in the world with an internet connection. And that way we can automate financial primitives, and we can deploy this infrastructure without middlemen like the traditional institutions. That's a really big trend right now. And the interesting thing is that these crypto assets that are powering these networks, they have a cash flow, and that makes them really attractive for investors like ourselves. And this is about building a new infrastructure for things like lending, derivatives, synthetic assets, and so on. So that's a very big trend right now, and we see many of these assets performing really well in this market.
Thank you so much. And now we'll go on to Niv. Can you tell us about trends in the cannabis and mushroom markets in North America, and how you think, and tell us a little bit about how you think this is going to translate into the Australian market?
Yeah, so thanks for having us on the panel. Look, what we've seen, I spent 2 years in North America in Vancouver, and if people at home watching recall what happened with medicinal cannabis about 5 or 6 years ago, names such as Aurora, Canopy, Tilray, there's now talk about psilocybin basically being the next big thing. And we've seen huge amount of money, not only from Silicon Valley, but also from family offices, investors abroad, backing psilocybin, and especially it's quite topical right now, as you can see I'm at home, impacting on PTSD, concussion, depression, anxiety. And the FDA is actually pushing to really speed up the process. And they actually granted just recently what's known as breakthrough therapy status for the basically psilocybin, which is a derivative of the magic mushroom, in clinical trials. So the whole space is really heating up, and we're co-investing and really getting behind it. So very excited by it.
I must admit, look, we're members of YPO, and we were at an event in Aspen last year on the latter, and yeah, it's really interesting what was all sort of people tripping in the 60s and 70s, and now it's getting sort of recognised for its therapeutic benefits. It's kind of It's quite mind-spinning, actually. So trying to link back some of the trends around blockchain and energy. A few years ago, it was hard to find a startup pitch that didn't have the word blockchain in it, often for no good reason at all. And we saw a wave of companies, mostly overseas, that raise money through ICOs. And for those that might not be familiar with the term, it means initial coin offerings. And this has thankfully died right back. And I think there was, I think the whole word blockchain ended up being sort of associated with, snake oil. There was a lot of distrust that it was really volatile. And people like me didn't really want to touch it with a barge pole because it didn't really understand it. And that was the real reason I wouldn't have invested in. So John and Hendrik, sort of Power Ledger, an energy trading platform out of Perth, raised over 30 million in 2017 in its ICO. And I just, tell us about it. Is there, have you got some sort of reactions to some of those things that I was just saying? I mean,
certainly. You probably need to break it into two things, though. You've got Power Ledger, who are using blockchain both for what I understand, a cryptocurrency type purpose, but also for a proof of electron or energy purpose, so security, if you like. So putting aside the crypto side, which maybe the other panelists could talk about, from our point of view, when it comes to using blockchain to certify energy, we actually just don't think it's necessary. You can already do that today with an electronic meter or even an analog meter. So what their basic business model, aside from the cryptocurrency side, is based on is being able to sell solar from your house to the neighbour next door, exporting and then using the grid to transport those electrons to the neighbour to be able to purchase. And that's a great idea. It's not actually that hard to do even with meters. You don't actually need the blockchain to do that. But it's got a fundamental problem. And the fundamental problem is, as I opened up with, our grids weren't designed to send power back the other way. They've been designed to send centralised. So what we're actually doing is we're trying to create a decentralised grid that's not built to take it. So until you solve that problem, all these technologies that rely on, or business platforms, if you like, that rely on exporting energy for whatever purpose, whether it's to sell to your neighbour or to provide services to the grid or even to sell to the wholesale electricity market, won't work if the network operator stops you from exporting, which is what is happening all over Australia, and it's happening in lots of other parts of the world as well.
Yeah, I agree with what John said there. The blockchain word became a buzzword during the 17 ICO market that you mentioned as well, and that ICO market is not there anymore because that market is all regulated now and only open to sophisticated investors like ourselves. But a lot of companies were attracted by the money that were flowing around in 2017, and that meant that a lot of people and companies were using the word blockchain where they probably didn't need to use blockchain. And the fundamental innovation here is to create decentralized networks, and that doesn't really square with companies using blockchain or crypto assets, because what we try to create here is truly decentralized networks with no company behind them. That's the whole revolution here, to create something that is what we call trustless and doesn't depend on middlemen. So for us, it doesn't make much sense, and I think the market is starting to realize that now, that the word blockchain was overused, and in many cases it didn't mean much more than a decentralized database.
Yeah, I think that's been cleaned up now, isn't it? People just, there's a bit more discipline about using it.
Yeah, absolutely.
Yeah, I mean, and quite rightly so. I must admit, when I would get a pitch deck across my desk and it had blockchain or whatever in it, sometimes I used to just think, what? Doesn't look like there's any evidence really of any of this here, but it just seemed to be the buzzword for a while, and things have changed. Vpply, there's definitely a huge upsurge in interest in cybersecurity right now. The Australian government's really jawboning the need for it. And in your view, why has this been pushed so much more strongly than ever? And is it a sign for momentum going forward?
Well, I would say that this is happening not only with the Australian government, I think, with a lot of the other governments as well. For sure, right now is kind of the momentum because of just look what's happening around right now. Lots of people, companies are working remotely. So there is a need to review and rethink the defense of the data that is going back and forth. And also, I think that the majority of the world's enterprises understood that the corporate domain or corporate perimeter is not the same anymore. I mean, like all the employees are sitting in different parts of the world working with the corporate data. And for sure, the need for the cyber defense and the proper protection capabilities is tremendous. But that thing was not the same, but this was always needed last year as well. But right now in the COVID situation, we just, this catalyzed the even bigger need and just rethinking the cyber defense and how it's important for companies to sustain. And this is really treated as one of the significant topics for the daily agenda of the higher management in the company. So
thank you for that. I couldn't agree more. I think that, with the rise of the dependence on technology across all businesses, whether or not they sort of see themselves or position themselves as tech companies, any business that is not gearing up on tech is going to get left behind, I think. And, with that.
Yes.
Sorry.
And actually, just referring back to the previous conversation, I'm happy to say that I met most of today's panelists back in 2018 when we were actually pitching about the blockchain security topics and how the bad things that happened during the ICOs in the 2017 influenced in the very negative way the perception of the blockchain. But even right now, even us, the Kaspersky, the cybersecurity company, we have one of the innovative projects inside, like also focused on the blockchain because of the very, very simple reason. And during the COVID time, we saw that it gain even bigger attention. Why? Because the platform we have is the blockchain-based voting platform that allows for transparent and verifiable votings. And what we see right now in many countries, people cannot just go in the vote, or they cannot do polls by the regular manner. Like people sit at home, so they are thinking the digitalization of the governmental services, and solutions like that will definitely gain reviewed perception to help the governments and help the enterprises be more technology enabled.
I think it's great. Look, it's so topical at the moment, isn't it? With the US accusing China of stealing, very valuable kind of information, particularly including relating to the development of vaccines, both in the US and in the UK. And Yeah, I think that's really brought the whole cybersecurity thing up into people's consciousness as well. It's something that all businesses, I think, are obviously going to have to invest quite heavily in. So, Niv, it seems that the cannabis 2.0 investment wave is gaining momentum. What, in your opinion, are the sort of key lessons to take away from the first attempt? And do you think the sort of risk rewards are the same? And what would you suggest companies might do differently this time around?
Yeah, it's a really good question. I mean, I was, as I mentioned, fortunate enough to be up in North America when it really started to open up. The issue that they had in North America and also down here back in Oz is that just an oversupplied market. So you saw farmers, instead of growing vegetables, were starting to grow hemp and CBD, and that caused a huge oversupply in the industry. So, look, I think for medicinal purposes, I think CBD is here to stay. I mean, we actually floated a business on the Canadian Securities Exchange called Sweet Earth, and they're actually selling, they're farm to seed essentially, or seed to essentially product. So they're doing all the way from growing to extracting from the oil out of the cannabis into finished goods and finished products. And they're growing, making basically oil for nutritional purposes, but also through hair products, skincare, teas, and multitude of different products, right? So that's really interesting. So I think the Cannabis 2.0, to answer your question, Andrea, is all about brands and brand awareness. And I think having visibility through that, I think that's really important. Tying it back to magic mushrooms and impacting on mental health it's really interesting. We've seen some notable investors, and an example was Peter Thiel, who recently invested $40 million in a company called Compass Pathways, right? So, look, really exciting how the market has evolved. And just like any market, I think those companies that are able to adapt and change and alter with the times will prosper and succeed.
I think that last statement is probably applicable to everyone at the moment, isn't it? I mean, the companies need to be sort of extending their runway and looking out for opportunities that have been generated by the current crisis. And probably one good thing for investors is the ones that aren't going to cut the mustard are those ones going to be weeded out, I think. I actually, when I was in the US last year, I bought some, skincare product, which was, it said, pure CBD oil, and I didn't know what it was. I didn't realise it was sort of a cannabis extract. It was quite good, actually. I don't think you can buy that here yet, though, can you? I don't know. John, turning to you, how can founders in the energy space take advantage of their ability to out-innovate the big players in the market? Where are the key opportunities?
I think if you're talking about founders, I guess you're talking about startups.
Yep. Sorry, a bit of a bias there.
No, that's okay. We were a startup once and probably a bit away from that, but still. I think certainly within the electricity world, renewable energy world, and the grids that we have, this is certainly how we found our space. We had a vision for a future grid, which is, as I said before, a distributed one with renewable sources, mainly from rooftops. It's the most economic and efficient way to produce electricity. And so when you have disruption like that, I mean, we're talking about something that's at least 120 years old, with some incumbents that have been in there for a very long time. You also have, your traditional fossil fuels and your petros. For the most part, I can't think of a major petro, for example, that doesn't have a venture fund focused on renewable energy generation. So they have seen that this is going to be the future. And so when you've got that amount of disruption, there's actually opportunities everywhere for smaller players that can come up with the solutions to enable us to get to get to that endpoint, which is the distributed grid. And so it's actually, to a certain extent, I think it's your advantage being small, because you're not tied into your traditional business model. You're not, for instance, listed where you have shareholders to maintain promises to in the public sphere, etc. So opportunity abounds for startups, I think, certainly within renewable energy in the future.
I suppose moving away from the startups up the chain a bit, Mike Cannon-Brookes talks about his vision for having huge kind of generation of renewable energy and by way of wind farms and solar panels in the Northern Territory, and running a cable under the ocean to Singapore. And I think he was saying, numbers like 800 million, there's an $800 million a year source of revenue there. And he has a vision for cables going under the ground to lots of other countries to actually bring in significant amounts of revenue. It's obviously a huge capital project that requires, pretty amazing leadership, I think, to pull it together financially. I mean, what do you think about huge visionary projects like that?
Well, I personally don't think that that's necessary. I think we've got the grid that we have in place in countries like, I was talking about cable to Singapore. Singapore's got enough rooftop space to be able to power itself. I think it can also supplement itself with wind and other forms would be economically and possibly even environmentally a better way to do it. We in Australia, for instance, think it's something like 150 terawatt hours of energy is used every year, and rooftops are good for that and more. So the point we try to make is that why build massive wind and solar farms and drag that power into the metropolitan areas for consumption when you've got rooftops available to do that within the metropolitan area? It's economically the best way to do it, and also environmentally. The problem with that, though, is, and this is why we've come up with our Alexis technology, is that the grids were not designed, once again, to send that power back the other way. And so we've seen in Australia, we've got the greatest penetration of solar in the world, but we've got to the point, and in particular in South Australia, where I am, where at about 15 to 20% level, you can't actually put any more solar onto the grid. 15 to 20% of the transformer capacity, I should say, and so without having what the engineers call voltage problems. So unless you can address that, you can't actually end up with what we're trying to do, which is this most economic way of doing it. So we've got the same vision as Mike Cannon-Brookes. We want to do exactly the same thing, in the sense that we should be powering Australia and then the rest of the world with renewable. But we just think that there's a smarter way of doing it if you've got the technology to do it, which we think we do.
So his vision is around, a massive opportunity to generate substantial revenue for Australia. Do you see that you could generate sufficient amount of energy from rooftops to be selling it to other countries like Singapore, that feels like it's got this a risk because it's so dependent on buying energy from Malaysia, for example?
Yeah, I think we should do that in two steps. One is use our rooftops that we've got to power ourselves first. I mean, through that process, you're going to really lower the cost of electricity, which is one of the major inputs into industry in Australia. That's going to drive, hopefully, a regeneration of our industrial base and start bringing some manufacturing back home. And then secondly, to export energy through those sorts of projects, if that was feasible. I do question some of the practicalities about running those sorts of cables undersea. I think there's security issues around that sort of thing, etc. So, but I would focus on Australia first and generate, using the rooftops that we've got, enough. And there will be a little bit of surplus, because we as I said before, that statistic is that we have enough to at least do our own and a little bit more. So do that first, and then address these other projects. would be the order that I'd suggest we do it in.
And do you think it would be a good idea to have, install big batteries similar to the one outside of Adelaide?
Absolutely.
To support other capital cities in Australia?
Well, you wouldn't do it necessarily to support other capital cities. You would do it within your capital city. So what we're all about is a decentralised distributed network. So lots of smaller batteries within those C&I spaces, providing stability services, etc., that are needed on a distributed grid. The Tesla battery is a good example of one part of the puzzle that you need to be able to have a distributed grid. Its function is more on what they call the transmission lines. So we have large wind coming into the city over high voltage transmission lines. It deals with the intermittency of that wind, whereas the batteries we're talking about within the metropolitan area will be dealing with the problems that are faced with intermittency, voltage, all that sort of thing within that area. So distribution basis, part of the grid, if you like, the distribution part of the grid versus the transmission side. So yes, to answer your question, it's certainly we need that. But once again, just to drive home the point, we can't do anything with these batteries if we can't actually export back to the grid. And that's the point. It's whether it's batteries, peer-to-peer trading through Power Ledger, sending solar back, anything really that involves exporting from the site to the grid in the other way, can't be done without addressing the issues that causes.
And maybe it would be a good move to have, more buildings in Australia having their solar panels on top, coupled with on the roofs, coupled with their own batteries for their own building. I'm aware that we're almost out of time, so I might just go on to Henrik for our last question. Henrik, can you tell us what is a crypto fund, and has blockchain not passed its peak? Is there is there actual genuine utility in crypto assets, that other traditional stores of wealth, for example, cash, don't have?
Yeah, for sure. So we actually see more and more investments into crypto assets by institutional investors and family offices and so on. And especially, I think, in this macro backdrop where we are right now, with central banks around the world basically printing money, and we have QE unlimited today, which means that there will be an increased demand for scarce assets. And Bitcoin is a prime example of that, I think, being more scarce than gold itself. And we've seen legendary investors like Paul Tudor Jones come out earlier this year and saying, yeah, I'm going to put a percentage of my portfolio into Bitcoin for this exact reason. So there's an increased interest from traditional investors, hedge funds, and so on into these assets. And there is an increased understanding today where the value lies. And outside Bitcoin, it seems to be all about DeFi today and decentralized finance. That's something we have focused on since we started Apollo Capital 2.5 years ago. And that is creating a real utility for people. If you can access these financial services with just a mobile phone and an internet connection, that's a true 0 to 1 innovation. And that's gathering a lot of investments and interest from some of the biggest investors in the world right now. And that's why we see the returns in the market that we're seeing right now.
Thank you so much. Well, I think we're out of time. I'd like to thank Jonathan Ruddick, Niv Dagan, Henrik Anderson, and Vpply Mazakov for joining us today and for giving us the benefit of your expertise in your particular areas. It was a really interesting panel that I learned a lot from, and I hope that the audience enjoyed it too. I'm sure they did. So thanks very much. I'm Andrea Gardner from Gelix Ventures. Thank you.
Thank you, Andrew. Thank you all.
Thank you.
So that concludes day one of Venturing Capital. I hope you enjoyed the presentations. I hope you enjoyed the panel session. And I also hope you enjoyed the keynote from John. As I said, what I love about this space is that we know that the people in it are working 24/7 to do everything possible to build their vision and to do what's required to make their business a success. And that is what inspires me and drives us to keep on building. Now, because of the demand for this event, both from the investor side and also from the company side, we're very excited to announce to you about day 2. Now, day 2 of this event is going to be held on August 14th. What's really nice about a virtual environment is we can set things up however we want, really. So what we're going to be doing is on August 14th, we're going to be hosting day 2 of Venturing Capital. So it's jam-packed with great presentations from CEOs, as well as panel sessions and also thought leaders and business talks. We're going to be bringing that to you on day 2 as well. So I look forward to you joining us for day 2 of Venturing Capital.
Thank you.